Welcome to day 13. Can you believe it? Doesn't feel like it? How about to those who've been studying all this time? Are you over it? Is it seeping out of your ears, all that knowledge? A little bit room left? Is that big rock, little rock analogy? You know, you put the rocks in the vase and you can still fit more in there. They just need to be smaller. And finally, you can put water, sand, and then water. You got some room in there. What do they say? We use about 10% of our capacity. But we need to do it in increments, don't we? We need to take breaks, give it time to shake down a little bit. I was learning a guitar part the other day, and it was not quite getting under my fingers yet, and I just put it aside, came back the next day, and it clicked. And that's the way the brain works. Doesn't matter if it's guitar or real estate or anything, right? You just have to give it time to process, and it's doing that in the background, like all those apps on your phone or on your computer that are bogging it down. You don't even know they're all running behind the scenes. Well, your brain is running behind the scenes. So work that to your advantage. Don't forget the Pomodoro technique. You know, give it a good hard 25 minutes. Make yourself get up, walk around the block, do a few high knees in the living room if it's raining. Get some blood pumping, go do something fun for a minute, come back, go back at it. It also helps to change the scenery sometimes, because I know I think back about what I was learning and where I was when I was learning it. When I'm sitting there struggling through a test. Wait, oh yeah, that's when I went out on the porch. That's chapter 11. I was sitting out there in the sunshine. Oh, that's chapter 12. It was raining. I was struggling, right? Whatever it takes. It's all about the tips and tricks at this point. So speaking of chapter 11 and 12, let's do a little bit of review. We're going to get into 12 today. But first we're going to finish 11. Did some math. How'd that math treat you? Did you do a few practice problems afterward? You know, making some sense? Origination fee. How much is that going to cost? If a 1% origination fee, 1% of what? There it is. If it's loan related, it's the loan balance, the loan amount, right? It's the loan amount we're going to be working with, because that's what that lender cares about, right? Excise tax. Let's pull one back from the dead from weeks and weeks ago. Excise tax. What is that based on? Sale price, not tax value. That might be an easy one to get wrong, but excise tax is all about basically a sales tax. It's a tax on what you paid, $1 for every $500. Yeah, good job. Loan-related things are going to be based on the loan amount. That's what we're going to do a lot of today. We talked about the Federal Reserve System and how it influences the economy. It manipulates things so as to hopefully keep things stable in the face of worldwide events sometimes, and policy choices by administrations, and how can we manipulate all of this to help stabilize the economics. We talked about the primary and the secondary market. What's the primary market? What's an example of things that go on in the primary mortgage market? Yeah, that original point where loans are made. You're walking into the bank, you walk in and talk to the loan officer and say, I want to buy a house, need to borrow your money. That's the primary market. They're taking all your information down. They're getting your tax returns, your bank statements. They're putting it all together. That's the loan originator that you're meeting that first day or interacting with online. They accumulate that preliminary data, take your application that you sign saying, I promise all this is true, I'm not being fraudulent. That way they get you. In case you were being fraudulent, they can come back and say, you said it was true. Uh-oh, okay. But you were being fraudulent, therefore loan fraud. When I say loan fraud, think red lights flashing. It's like the biggest most fearsome thing to deal with in this business, besides the real estate commission coming after you because you did something wrong. But loan fraud. Once upon a time, there was an agent in South Park, and she met a man who was very successful, and he chose her. He said, I want you to be my agent because I've got some deals I'm putting together. I'll be the consultant. You be the real estate agent. I've got the other players in place. And she did it. And at one point, I believe I'm trying to remember what the book said because she wrote a book about it. I'll tell you who it is in just a moment. He ended up getting commission without having a license, and a handful of other things were going on. And she said in her book, and on the speaking circuit where she travels around and talks about loan fraud and how she accidentally fell into it, I had this small little tickle in the back of my mind, had this bad feeling, but everything was going so great. The money was rolling in, didn't seem to be that big a deal. And she just went with it until one day they called her. The front desk person at her office said, there's 2 gentlemen here to see you. 2 men in 3-piece suits. And she took them into the conference room, and their jackets kind of fell open, and she saw guns and badges from the FBI field office in Charlotte, North Carolina, because there is that. And they said, Miss Pasut, who do you know this man? The consultant guy. Yeah, I know him. And about 5 minutes later, after questioning her, they just stopped and they said, you know what? It's probably best for you right now to consult an attorney, to go find an attorney. And I thought that was very nice, because in the movies and TV shows I watched, they would have had her in the van headed to Virginia to put in a small room with 1 light bulb and interrogate her, but they let her go. They knew where she was. And as soon as they left, she went and talked to her broker in charge, who said, oh, don't worry about it. That happens from time to time. And I'm like, wow, I don't want that to happen from time to time to me. Long story short, she ended up going to Martha Stewart prison, the same one in West Virginia that Martha Stewart went to for loan fraud. Because of her affiliation with this group, they determined that there were some things done wrong. At one point in that whole mess, she had to talk to the real estate commission. They needed to know. And she remembers, she said, I remember being on the phone and I heard the breathing of the real estate commission person as I'm explaining what's going on. And it was just this pit in my stomach. And guess what the real estate commission did when she explained to them that she was being investigated for loan fraud, being involved in that situation? Guess what they did? She had not yet been sent away. By the way, she's a single mom of 4 kids. She had been very successful in real estate. She was always in the high-end market and selling lots of houses. I remember her advertising. She ran an ad one time where she was popped out of the top of a limousine, and she said, this is how I show houses to my buyers. And I remember at the time thinking, well, number 1, good for you. Number 2, good luck ever negotiating your commission and maintaining it to a certain level. They're all going to think you're making too much. But hey, she did better than I did. The real estate commission gave her 9 months to close out her business. They did not bring the hammer down right away. They were like, in the situation, in the interest of the situation and all that's been considered, and you're coming forth, you're being straightforward, button up your business, get paid for these last few deals before you go away to West Virginia, which I thought was pretty cool. She went away. She got out. She is out. I think she got out maybe around 16, 17, 18, something like that. I think she was only away for maybe 1 to 2 years. And her name is Holly Pasut, P-A-S-U-T. And you can look her up on Amazon and get her book and read it and learn all about how not to become embroiled in loan fraud. She was on the speaking circuit, and then that illness, which shall not be named, took over and I think kind of derailed some of her dates. But I think she's back at it. She talks to realtor groups, to real estate companies, and says, hey, guys, it could happen to you too. Here's how to avoid it. So she's doing quite well in light of the situation. She may even be doing better than she was in real estate at this point. So, loan fraud, 30 years in prison, maximum sentence, $1 million fine. And what are some examples of loan fraud? Well, obviously, the most glaring one that we're going to learn and focus a lot about today with Chapter 12 on closing math and the closing statement What is the closing statement or the settlement statement? You might also, some old schoolers might call it a HUD-1 because that's the only way we used to use. It's the only thing we used to use, but now it was revamped from the after effects of the Dodd-Frank Act, which was legislation enacted after 2008 to help fix some of those problems we had that led up to that catastrophe. And so now there's more disclosure required. Ooh, that's a good one. Twee. Yep. Telling the lender you're going to occupy an FHA loan when you're actually renting it out. Yep. The reason this one is an issue is when you get financing to buy a property, they want to know, is this going to be owner occupied or are you going to use it as a investor, as a rental? And if you lie and say, well, I'm going to live there, but you never actually live there, you defrauded the lender because you did that so they'd give you the lower interest rate because they give you lower interest rates on owner-occupied loans than they do on investor loans. They also tend to require less down payment on owner-occupied homes than they do investment purchases, which is another reason people would try to get away with it. Let's see. What else about loan fraud? Here's one. You ever heard of a gift? The parents are giving them a gift to go toward their down payment. Well, what is a gift? It's not a loan. You don't repay a gift. So you're driving them around. Back in the day when we used to do that, you're driving them around in the car. The first time buyer client of yours is in the back seat with their parents, right? Everybody's looking because the parents are throwing the gift into the mix so they have a say in the matter. And you hear them talking to each other, and the kid says to the parent, I'm really thankful for your help. Thanks for giving me that gift and signing that letter, giving me the $10,000 or whatever it is. I'll make sure to pay you back like we talked about once I get my tax refund and once I get some of this money back. What you've just witnessed is the plans to defraud the lender, right? Because it's supposed to be a gift. They signed something saying, I don't expect this to be repaid. And why is it a big deal? Because maybe they can only afford it if it's not a repaid thing, and therefore they're too close to the limit of being able to afford the loan itself, and they're more likely to maybe default on the loan because the lender didn't know that they didn't even have all the money that they claimed to have. They only had it because of the gift, but the gift was actually going to be repaid. And can they repay that gift to the parents and still maintain the house payment? So full disclosure, the lender's got to know everything. There are brokers out and about who ride the line sometimes. They kind of engage in, oh, you know what? We're trying to handle these repairs. We've maxed out the most a seller can pay for the buyer's closing costs. Let's just handle that money. Let's just give it to the seller or give it to the buyer, whichever way they decide needs to happen. Or maybe the agent giving money to the buyer. Let's just do that outside in the parking lot before we go in. And you know what? The attorney doesn't need to hear about this. Sometimes the attorney hears about it too, and they just keep their mouths shut. It is tough, guys. When you've put in 60 hours of work and you're there at the finish line and you're somehow maybe accidentally a witness to this sort of planning, and now your ethics is kind of flashing in your head and you're just like, am I going to be a party to this and risk something kind of breaking loose and somebody getting caught? What you do know is if people do get caught, you, the agent, are going to be thrown under the bus before they're going to throw their parent or their child under the bus. So keep that in mind, right? If it all goes well and nobody gets caught, you still have the fact that it was wrong to deal with. But if people start talking, you're probably the first one that's going to get thrown into the mix. So it's not worth it, is it? It's a big deal. Secondary mortgage market. Let's fast forward. Now that lender has a whole bunch of loans that they've made to people. They've categorized these. They've put them in boxes. They've said this batch of them are similar types and similar risk, similar credit scores. And why that matters is more chance it's going to get paid back or less chance if it's maybe a lower credit score. So they batch them up. They do that so that they have equal, sort of closer to equal value in the secondary market. They can sell them to other institutions back and forth. And the marketplace within which they do so is one of three: Fannie Mae, Ginnie Mae, and Freddie Mac. What if it's an FHA or a VA loan? Well, typically people use those because they either need help with the down payment or they need help because their credit score is not great. With a VA loan, you can get as little as zero down payment. We'll see that in a moment. Well, Fannie Mae likes A paper, good credit. Fannie Mae doesn't like the risky stuff, the riskier stuff. They want people to have more skin in the game in the form of more down payment, more equity right out of the gates. So the only way Fannie Mae marketplace will deal in FHA and VA loans is because Ginnie Mae kicks in and says, look, we will cover the risk for you. So therefore, go ahead and interact with those, Fannie Mae. But yeah, they do deal with conventional FHA and VA loans. But if it wasn't for these guys, oops, sorry, I just realized I'm not showing you stuff. There we go. There's Fannie Mae. Deals in conventional FHA and VA loans. If it wasn't for these guys, they wouldn't deal with the FHA and VA stuff. So, what are the types of loans? Conventional loan is for the lowest risk, the A paper, the best chance of successfully repaying. They're not insured or guaranteed by the government. They have nothing to do with the government. The government doesn't step in and say, we'll cover the risk for you when it's a conventional loan. They don't need to, because this is the least risky borrower. They're putting more money in as a down payment usually, and their credit score, their credit history is better than the typical borrower. So they don't feel the need to do so. Not insured or guaranteed. Those two words, put a little note, right? Insured and guaranteed off to the side in your notes right now. They are important, because what we'll see in a moment is with an FHA loan, it is insured by the government. So write FHA insured and then write VA guaranteed. VA is guaranteed by the government, and we'll get to those in a moment. Conventional loans are neither insured nor guaranteed by the government, and they are almost certainly going to be sold on the secondary market because they're such a sellable product. They're so nice and easy to sell. They're nice and neat, and clean, and low risk, like that nice shiny car compared to the beater that needs, a paint job and needs to be cleaned. You're going to sell the nice shiny one a lot easier. Lower loan to value ratio, more down payments. What that means, more equity. The borrower is putting more in it to buy it, right? They might be putting 10% down, 20% down, which means they have more of their own skin in the game. They stand to lose if it were to go to foreclosure. So they're more likely to make that a priority. Paying this mortgage is a priority to somebody who has more of their money in it. If they got a zero down payment loan, yeah, it would not be fun to get foreclosed with that, but you have hardly any equity, because remember, even the first few years of buying it, you're only paying down that principal by a few $100. We did the math. What's your principal loan balance after the first 2 months? It was like $300 less. Out of what? $400,000? Yeah, I'll walk away from that if I need to find a place I could rent to put the family in, since I'm losing the house to foreclosure, be able to put the groceries on the table, be able to make the car payment so I can get to work, get to my third and fourth job because times are tough. Yeah, if I have a couple $100, a few $100, even a couple thousand into the house, I'll let the house go, because it's much easier to save $1,500 a month on a mortgage payment. Yeah, terrible to have a foreclosure on my record, but when times are hard, you have to make hard choices. So that's why conventional loans are less risky, because if I had 20 or 30 or 50,000 of my money that I stood to lose by letting that house go into foreclosure, I would try to do some backflips to figure something else out besides letting it go to foreclosure. It's got to meet various guidelines. Conventional loans, up to a certain level, are called conforming loans, meaning they have to meet various guidelines to be in that category. And that's what that whole process, if anybody's gone through the loan process, the application and approval process, it's infuriating sometimes. You've never done anything wrong financially, but they treat you like you did. They lump you in with the worst of the worst because that's the process of making sure you conform to all the guidelines so that they can make it a nice sellable product once they grant you the loan. And that requires sending them things and resending those same things and proving and writing, sometimes writing letters to explain why there was a gap in your income because maybe you had a job change. Was it a change to a similar field? You have to explain that sometimes. All the craziest things that come out of left field, sometimes they ask for your client to have to explain. And you, as a broker, what that means to you is help them through it. You don't write the letter for them, but you help keep them calm. And the best way to keep somebody calm is to prepare them in advance for what could happen. And you say, look, guys, you're about to apply for this loan, but just be prepared. They're going to not give you special points because you're you or you're cute or you have great credit. They're going to ask you for the same thing over and over. Sometimes they might ask you for extra clarification, extra paperwork. They're not picking on you. They're deciding whether to give you a 6-figure loan or more. Therefore, you're going to have to ride it out. You're going to have to be patient. And then when that does inevitably happen, they're going to think, I could either get mad right now or I could remember that Neil told me this could happen. So everything's normal. That's the biggest thing. They're looking and they're getting nervous. Is this something abnormal? Are they mistreating me? Is this thing falling apart? You told them everything's normal. Kind of helps them move on toward the final goal. Give that lender what they need. Keep it going. Loans past a certain point because of the level, the expense of the house are considered jumbo loans or non-conforming loans, but they still fall under the conventional category. Now, if you put less than 20% down on a loan, that lender gets nervous and they say, you know what? You're more likely to default. We feel like for whatever reason, I don't know why 20% is the number that they like, but it is. So if it's less than 20% down payment, they're going to require you to buy an insurance policy called private mortgage insurance, PMI. Have you ever heard of that? Those initials, PMI, private mortgage insurance. That adds to your payment. You already have PITI, principal and interest and taxes and insurance. But now you also, on top of that, have to pay PMI, and it's because you're putting less than 20% down payment. You have less than 20% equity in the home from the very beginning. So, testable items. It's an insurance policy. Who does it benefit? Who does PMI benefit? Yeah, the lender, not you. But who gets to pay for it? Now's when we're going to start keeping track of which side pays for what. So keep a page in your notes, seller and buyer, and who's paying for what. We already know seller has to pay excise tax. Officially, between you and me, it's negotiable. But for the purposes of this class and the test, the seller pays it. That is a seller expense. Excise tax is a seller expense. Now we're getting into the loan things. Who's benefiting from having this loan? The borrower. So everything related to the loan costs are the borrowers, including PMI. Now they had a house payment, PITI, of $1,800, but they're putting 5% down payment. They're coming into this with a less than 20% equity stance. Therefore, they have to pay another $200 a month for PMI. If that's the payment they will send, it'll be $2,000 instead of $1,800 because they have to have that PMI included. The good news is it can go away. When they reach the point of having 20% equity in the house, the PMI can drop off. Now, it should automatically drop off when they hit 22% equity. But when they think they might be at the 20% mark, they could petition the lender and say, look, I think I'm there. Would you go ahead and drop it off? And the lender will say, let us do some checking, some investigating. They might even require them to pay for an appraisal to prove the new value, the current value, because maybe this is 10 years in, 5 or 10 or 15 years in. Maybe they've been making extra payments like Twee does. Maybe they've been making improvements that make it worth more. Maybe the market has increased so steeply in the last couple of years that they've reached it sooner than later. They call their lender. They say, I think I've hit the 20% mark. I don't want to pay this PMI anymore. It's stupid. The lender will say, okay, let's see about that. And if they find that out, great. You just saved yourself that extra little bit of your payment. The lender makes the loan, and some of you did a great job since Monday, and I appreciate that, sending me questions that you ran across that you had questions about. So I hope you've seen those explanations. And what a lot of those had in common was involved this little tidbit, and that is the lender makes that loan, that 95% LTV loan, because you're putting 5% down and they're going to loan you for 95, the remainder, right? They make that not necessarily based on the sale price. What else might it, if it's not the sale price they loan you the money, they calculate that 95% on, what would it be? What other number would it be? Yeah, it's going to be the lower of either the sale price or the appraised value, because the lender is leaning hard on what the appraisal comes in at. That's their third party opinion of value that they're relying on. They're not going to believe the brokers. Just because somebody listed a house for $315 doesn't mean they're going to get $315 for one thing. Maybe in certain types of markets where buyers aren't falling all over each other to buy something, just because a seller lists it for $315, it could be actually worth $275. There are such a thing as overpriced listings. What I actually call a list price is a wish price. That's what they're hoping for, right? Let me now step in as buyer agent and figure out, are they crazy or not? Did they come up with that number from air or other places, or did they base it on actual real comps? By the way, one of your duties as a buyer agent is to do a CMA, a market analysis, to make sure it's even in the ballpark of reality, right? So the lender makes that loan based on the lower of the two, sale price or appraised value. PMIs for less than 20% down purchases. And it's an insurance policy provided by a PMI company, private mortgage insurance company, paid by the borrower. And it's temporary. It doesn't stay for the whole loan. It goes away when you get somewhere around that 20% equity mark. That is the conventional loan type. The other one is an FHA. An FHA loan might be attractive to someone who can't get a conventional loan. In fact, you might have a buyer prospect come to you and say, hey, who do I need to talk to about getting an FHA loan? And one of the things you could say is, well, why are you trying to get an FHA loan? Let's try for a conventional first. You should always try for a conventional first. You just might get it because it's going to be a better interest rate. It's probably going to be lower fees. And it's probably because they were told the words FHA loan, maybe because they think they have to have less down payment, which they typically can do, put less down to get an FHA. But try for conventional. Even a VA person, a military veteran might come to you and say, do you do VA loans? Do you work with VA buyers? You'd say, sure I do. But let's talk to the lender and see if you could get a conventional loan first. Why would I do that? I'm a veteran. Well, because it's going to be cheaper. The fees are going to be less. The rate probably is going to be better. Yeah, but I don't have much for a down payment. Well, now there's a good reason to go with VA. But just because you could get 100% LTV and not have to put anything down doesn't mean you should. Like, it's available to you because you're a vet, but you also have $50,000 available in your possession. And maybe if you use some of that, number one, your payment will be less because you're not borrowing 100% of the value. Number two, you can go conventional loan instead of VA loan, and the fees will be lower too. And the process will be quicker, by the way. To get approved for a VA loan takes longer, probably just because, for the sole fact, the government's involved. But there's more things to be checked. Rule of thumb to allow for maybe your typical loan, like a conventional, even an FHA, could maybe be done within 30 days from contract to closing. FHA, add 2 weeks to it. VA. VA, add a couple of weeks at least. None of that means anything for the test. Talk to the lender, see what they're seeing in the real world when you get out there. Don't quote those things to your borrower just for your own information. Just know that VA loans are probably going to take longer to get closed. Okay, FHA. Here's that first bullet point that you've already written in your notes. They are insured by the government. They're not guaranteed, they're insured. It means remember that PMI thing we just learned about? There's a version of that with an FHA loan. It's called a mortgage insurance premium, MIP. And I always think in my head, those of you who are older than 40, MIP, KEY, MOUSE. Sorry. Anyway, Disney fans. FHA loans, insured but not guaranteed by the government. FHA, the FHA organization does not originate or make the loans. The lenders are making the loans still, just like they always do. But FHA steps in and ensures that the MIP, the mortgage insurance premium, is because of FHA. And the borrower, it works the same way as PMI. It's just called something different. It's handled a little differently, but it's essentially because the borrower has less than 20% equity in the property. That is it. Much more likely that they're going to have less than 20% down or equity in the property when it is an FHA loan, because that's one of the main reasons to go with an FHA loan. They allow for a lower down payment. Currently, that level is 3.5% down minimum. Conventional tends to be 5% down minimum. There's some exceptional programs sometimes from time to time. So what you need to know for the test is it is insured by the government. It is not guaranteed or insured by the government through FHA. The lender themselves makes the loan, set the rate, approve the borrower. All of that is done through the lender. FHA does not do these things. They don't originate loans or make them. And then the borrower has to pay MIP. Now, the thing about conventional loans versus FHA loans is the MIP never goes away. Write it down. With an FHA loan, one big reason if your client is on the fence deciding which one of these ways to go, maybe they're thinking to themselves, well, if I go with an FHA loan, I don't have to put as much of my money as a down payment. I know some of the fees are more expensive, but I'd rather keep my money to do some other things with. If I go conventional, I have to put more money down. Well, one big deciding factor might be if you go conventional, you could eventually get rid of that extra PMI payment once you can prove you have 20% equity. If you go FHA, you never can. The MIP stays for the whole loan term. That's big, isn't it? That adds up. Big reason to go ahead and gut it out. Maybe let's just go for the conventional if we can. If we're close, that means I can't buy the car as soon as I wanted to. I can't drive to closing in the new car. Oops, wait, stop, brake squealing. That's another thing you add to your, hey, let me warn you about this stuff up front list. Tell them to stop buying things. Don't get anything, certainly nothing on credit. Don't even go to Rooms to Go and get their credit card or Best Buy. Now, your lender that I've connected you with is your financial advisor. Run everything through her to make sure you are not going to harm your chances of buying and getting this loan. Even moving big chunks of money in and out of your accounts. All of those things cause the lender some frustration, some concern. Therefore, they shouldn't do any major financial stuff without talking to the lender about it. Will this harm my chances of getting this home loan? FHA loans, positives and negatives. The good stuff is you could get in for less down payment. You could get in with a lower credit score. Another reason to try for conventional, but they reject your client because their credit score is just too small. Well, now go try FHA. It allows for a higher debt to income ratio. Remember, we looked at that math and it involved the 28-36 percentages, meaning on a conventional loan, no more than 28% of your monthly gross income should be toward your house payment. And no more than 36% should be toward both your house payment and recurring debt. Those numbers are higher when it's an FHA loan. You need to know the 28-36 for conventional. We don't give you any to know for FHA, but know that they can be higher. The back end ratio tends to be 43%, just as for your own reference point. So those debt to income ratios are higher, allowing for more of the person's gross monthly income to go toward their house payment. And as we already learned about prepayment penalties, not allowed with an FHA loan. They can refinance without having to pay a penalty for paying it off early. They might start out to buy the house initially with an FHA loan because they can just squeak by with their debt to income ratio, with their credit score not being perfect, with a lower down payment. But then within 5 or maybe 10 years, they refinance into a conventional loan. Well, this works fine because there's no prepayment penalty that they'd have to deal with if they want to do such a thing. The negative, the MIP never goes away. That's a big negative. That's FHA. Now VA. The VA loans are for military and their spouses. Typically, they're guaranteed by the Veterans Affairs Office or the government, right? That's why we say VA loans are guaranteed, FHA loans are insured. There's a guarantee in place, meaning that lender can feel confident that they're going to be protected in the event the borrower defaults. The VA, just like FHA, does not make the loan. They don't originate the loan. Lender still makes the loan, sets the rates, and approves the borrower. As with any good rule, there is an exception here. While the VA doesn't really want to originate loans because it's a benefit for a military veteran or military person, there's a chance if that borrower wants to buy a house in more of a rural area. Sometimes it's hard to find a lender for something way out in the sticks. So the VA might be willing to make a direct loan in that event. If it's a more rural area where no lenders are making loans for some reason, the VA could step in and say, yeah, okay, we'll originate this one because there's no other option. We don't want our veteran to suffer because of this, therefore we'll do this one. So that's the exception. What are the positives for a VA loan? Well, big one is no down payment. That's what gets everybody's attention. You mean I can buy a house with no money at closing? Sort of, yeah. No money coming from you to the lender or to the attorney, but that comes at a cost. You are allowed to prepay the loan without a penalty, just like FHA, no prepayment penalty. You could actually sell your house and let that buyer assume your VA loan. The veteran could let someone else assume their VA loan. That's why 2 minutes ago I said kind of only for military and their spouses. Sure thing, Danita. There you go. If anybody needs to screen capture this, there you go again. So 100% LTV, no down payment is one of the benefits of VA loans. No prepayment penalty, and they are assumable, but the VA would have to approve that person wanting to assume the loan. Up into the 80s, and Margie may have had some borrowers who did this or knows some people, some non-qualifying assumable loans were possible. Did you ever run across that in real life, Margie? Yeah. Didn't have to qualify. They could just buy a house and take over that loan and didn't have to go through the qualifying process. You can see how it would be very attractive to people, though. You mean I don't have to go through that process? I can just take over. I can handle the payments. I just don't need there's something that happened to me in the past. My score's not great. So I will make my payment. But like she said, be careful. They had to look real close. Who's still liable in case of default? Oh, it's the original one that actually did qualify? Yeah, that's a problem. Yeah, that's sort of like the same risk there, Twee. Yeah. So there are still assumable loans, including VA loans, but the VA would have to step in and say, who's assuming it? Let's run them through, make sure that we can approve them. So that in that way, it could be a non-veteran a non-military person who ends up with a VA loan because they assumed one, right? Negatives, there are some fees. There's funding fees that have to be paid at closing. There's an origination fee that has to be paid at closing. And for instance, for those situations where a veteran sold their house and let someone assume it, well, now that veteran can't use their VA eligibility because someone is using it right now. They've let someone assume it. So only one VA loan at a time. They would need to, that person they sold to would need to refinance or somehow get rid of that VA loan that they've assumed, so the veteran could be freed up to use it on something else, which is probably a reason that, if I had to guess, I have no stats to back this up, I'm assuming not very many assumptions are done, because that veteran wants to keep their ability and use it on the next one. One VA loan at a time. Couple terms that come into play with this VA loan type. Think, when you see certificate of reasonable value, think appraisal. They've got to use a VA qualified appraiser, someone who has gone through some training, who knows what the VA cares about in terms of appraisals. And that is a CRV, certificate of reasonable value, to figure out, is it really worth it? It's just the VA appraisal. VA and FHA appraisals require more, probably a closer look. And think about it this way. Why? Why do VA and as well as FHA appraisals, why are they more involved? Why can that appraiser really derail a deal or transaction? Because think about this, the government is involved. They're either insuring in the case of FHA or guaranteeing in the case of VA. Therefore, they're trying to help people that otherwise don't have a chance at home ownership. They want to make sure those folks are set up for success. If somebody's putting not much down and has not great credit, the government wants to make these programs available so that they can have a chance. Why would they let them buy a house that's going to need a new roof next year? Therefore, the FHA appraiser, VA FHA appraisers are going to probably say, oh, this roof has 30-year shingles and they were put on 28 years ago. No, seller's going to have to re-roof this thing in order for us to give you this loan. That does not mean the seller has to re-roof the house. That just means in order for them to sell to this borrower, they have to re-roof the house. What could end up happening is the borrower who's using an FHA loan could say, my lender won't give me the loan unless you put a new roof on it. And the seller could say, well, too bad for you. I'll just keep your $10,000 due diligence fee because I still get to keep it, and you can go away and find something that has a new roof. Puts more pressure on a buyer's agent to make sure the house that they put under contract for their borrower doesn't have those issues that could cause their borrower to lose significant due diligence money. I know, right? So when you're a buyer's agent and you have an FHA, that's why you need to talk to the lender first to find out what are the loan options available to my client before we go out looking. What if you did all this work, showed them 20 houses, only to find out, oh, they can't do a conventional loan. It has to be FHA, and the one they fell in love with was perfect, except it needed a new roof. Oh, and to find this out after they're under contract would be even worse, because now it's kind of on you. You've set them up for failure because they're going to have to walk. If that seller, in a market like this, sellers won't fix roofs. They won't replace roofs necessarily. So is your client going to lose that due diligence money? Maybe. Let's figure it all out up front. And that's a great example you can use to explain to them why they need to go ahead and get pre-approved. Some people are averse to getting pre-approved up front, either because they're trying to waste your time and be sneaky about it, or because they just don't want to hassle with it, or they think you're maybe trying to get a quick sale, or who knows what. But if you can give them logical reasons and examples like that of why it's going to be a detriment to them, that's when they'll listen. So that appraisal process is stricter with FHA and VA loans. They have to find out what is their entitlement. What are they entitled for? It depends on, was it a dishonorable or an honorable discharge, the length of their service, all of those things come into play. So when you have a borrower who needs to use VA financing, they should really talk to the Department of Veterans Affairs first. Go ahead and find out what is their entitlement first before you start looking. Let's see what your purchasing power is. Let's get that ball rolling. Let's get things started. And oh, by the way, let's talk to a lender about conventional options, and maybe you don't even have to deal with the VA. Oh, you qualify for conventional and you have the money available for the down payment. Let's just do that. It's going to be cheaper for you overall because all these extra fees and stuff add up. But VA is what we're talking about. Their entitlement depends on how long they served and the type of discharge. And then there is what's called a certificate of eligibility. It's the maximum amount the VA will guarantee for them. The maximum guarantee is the certificate of eligibility. Probably a good idea if you're remotely interested in VA military niche in the business, is to take a class right out of the gates while you're sitting around just learning how to find business and you have some time. Maybe even start by looking for an elective, a CE elective about VA loans. Maybe there's something like that, because you can carry an elective over from one year to the next, only one, but you can carry one over. You won't need it for your first June 10th, but you could use it for next time. And it would also give you the ins and outs more specifically about VA loans. There's also some designations out there. That alphabet you see behind some agents' names and their business cards. Margie's got quite the alphabet, almost all 26 letters, I think. But there are CRS and GRI and all kinds of stuff. There's one called, MRP, Military Relocation Professional. I have that one. And they go into the ins and outs and details of VA loans. So you could do that. It costs money, but then you get to use the letters. I think using the letters isn't as valuable as writing them out and telling the whole world why that matters, because they see some letters and they're like, okay, whatever, PhD, BABS, what does it mean? So it's nice to be able to say, this means I'm an expert at dealing with elderly clients. There's one for them too, by the way, SRES, Seniors Real Estate Specialist. There's all kinds of them. Just gives you that little extra level of expertise, gives you some insight. And then you can take that and become, your one cool thing about the SRES is you can be on the list with various nursing homes to be who they call in case some of their patrons need a realtor. That's funny, Darnell. Another type of loan. Well, first of all, what was the most attractive feature of a VA loan? What did you notice as one of the more attractive features of the VA loan? Yeah, the 100% LTV, the no down payment. What if there was a way to have that without serving in the military? For those who have not served in the military and who want to purchase a house in the more outlying rural areas, there is this, a USDA loan. It's guaranteed by another government agency, the USDA. They will make direct loans. It requires a lower to moderate income level. So it's for lower to moderate income borrowers who want to buy outside the city limits. And it's not even that clear cut. You actually would go do a USDA loan map search. Do one of those sometime. And you plug in the address and it shows you shaded maps of where in the county will allow for USDA loans. It may be nowhere. Some counties, even though the whole county is not a city limit thing, they may not allow USDA because it's not rural enough for their purposes. They're trying to help a very certain segment. So down payments could be as low as 0%. Interest rates are subsidized by the USDA to help the lower to moderate income borrower. The thing about it is the bucket is limited. The bucket of USDA funds can run out within the year. So don't just talk about USDA without knowing, is there still money available and is it funded? Is there still room in the program for more borrowers? They might have run out of USDA loan money. Inconsistent funding. Lots of other kinds of loans, depending on the needs of the client. You'll see in your book a purchase money loan. That means seller financing. Purchase money mortgage is seller financing, basically. A bridge loan helps somebody get from having the current home they haven't been able to sell yet over to the one they want to buy. For a little while, they own two. Bridge loan helps them bridge that gap. Buy downs, that goes back to the interest rate buy down. When it's an adjustable rate mortgage, for instance, you can buy the rate down and so have a lower than the market rate. Because right now, let's say rates are close to 7. If somebody can only qualify for 6.25, they could buy the rate down, purchasing discount points, and buy it down to 6.25 for the whole first year. And then part of the deal is the second year it's going to go up a little bit. The third year it's going to go up a little more. And that's what would be called a 3-2-1 buy down. Your rate's bought down, but it's going to come back up. You bought it down for the first couple of years. A reverse mortgage, we talked about a little bit. That's when you have a paid for 100% equity property. And probably for somebody that's in the retirement age of their lives, want to have a way to get some income that's dependable so they can get a check from the reverse mortgage company for that reverse mortgage. And that check is going to come to them every month. But what happens also is their equity goes down with each check. So it's limited. They've got to weigh their options. It's kind of a sad kind of math to have to do. Okay, how much is my house worth? $300,000? Well, then how many years of receiving a $1,500 or $1,000 check do I have? How many years worth of equity do I have in the house? Because at some point the house isn't worth, you've run out of equity. Oh, congratulations, you live to 100. Can't get a check anymore from the reverse mortgage. Package loans are when you roll personal property in with it. Would be sort of like model home. If you bought a model home from the builder and the loan includes all the stuff furnished inside. A blanket loan, when a developer has a whole neighborhood, they get a loan for the whole thing, and then they sell off one of the properties. Then they don't have that one anymore. It just decreases as they make a sale one by one. Construction loan is what you do when you are literally constructing a house. And it involves taking draws out along the way because you need to pay the foundation guys. So you take a little bit out and you give to them. And now you start making payments. You, the borrower, make payments against this construction loan because you had to take out the first chunk to pay for the footings and the foundation. Oh, now they're finished with the framing. Need to take some money out to pay the framing folks, pay the contractor to pay them, right? And you start making a payment, and it's going to be a higher interest rate because it's a dynamic kind of a thing and it's growing. Eventually, when the house is finished and you have that certificate of occupancy, you would convert that construction loan over to a regular loan, whether it's a conventional FHA, whatever it might be. Home equity loan is something you might run into quite a bit. When you're on a listing appointment, one thing you'll ask them is, do you have a loan? Do you currently have a mortgage? And they'll say yes. And then you want to also ask them, well, do you have a home equity line of credit? A HELOC, H-E-L-O-C. That is a second mortgage. It's considered a second mortgage because it too is against the equity in the house that's there. So the first mortgage is for purchasing. It's what you have in place to have been able to buy it. Over time, you built up your equity. And let's say you have 50% equity in the property. It's worth $400,000. You have $200,000 of equity. That means you can borrow against that $200,000. You probably can't borrow the full $200,000, but a bank will give you a home equity line of credit for maybe as much as 70 or 80% of that. And all that is when you have a home equity line of credit is basically a swipe card, and you swipe it and it comes off of that equity. So maybe 200,000 was the equity. Maybe you could borrow 160 as a HELOC because you wanted to put an improvement on. Maybe you wanted to build a sunroom. Maybe you wanted to use the HELOC money for something else like a trip or college education or even a car. Well, it's cheaper, lower interest rate because it's supported by your house. Cheaper, probably lower interest rate than a credit card might be. So it can really be a strategic financial tool to use unless you get crazy and people use it for stuff that doesn't add value back in some way. If they're using it to go to Disney for 5 times in a row, it didn't help them make any money, and then hope they have money coming in from other places, right? Ideally, it's good to use it to increase your home's value. And that's what a lot of people use it for, because that's a big chunk. 10, 15, 20, $30,000 for a maybe new heating and air system, maybe a luxury item like another garage or another room. Another term to know about. Oh, break time. Let's come back at 10:05.
Big brother wants to really make an impact on her. Happy birthday to you. Happy birthday.
Happy birthday to you.
Happy birthday to you.
Happy birthday, dear
Hannah. Happy birthday to you. Yay!
Poor Bruce, he just dipped as soon as you
Happy
played that.
birthday.
He's not here to defend you. He's like,
Oh.
he's like,
Aiden, your job.
I think all your hamster does is poop.
Yeah, that's all.
oh wait, no, I gave you these first.
All right.
I think you pooped everything else. Oh God.
Yeah, there's a bunch of waste more. Have a
Bring your present.
tracking clip. Oh, and it has that.
A cons-
There is that 20.
Welcome back. Here we are. Okay. Okay. Another term to know is subordination. How could subordination happen? Everybody hearing me okay? Okay, good. I'm seeing you guys. Good. Subordination, it's the process of putting another loan subordinate to a different one. And in your book, it talks about a developer situation where we're on page 374, by the way. If a developer were going to buy land to build homes on, and the owner of the land had a small, maybe took a small down payment, they could agree to release sections of the land as the homes are built and sold. So that construction loan bank is not going to allow them to be in the primary position, that owner's mortgage. They're going to require it to be subordinated to theirs. And so with the party's approval, you could move a lower priority lien ahead of a higher priority lien. It's in line based on usually recordation. The first mortgage is first in line in case of default, and the second mortgage is behind that one. Subordination, subordinating one behind another. Here's the process for getting loan approval. You meet the loan originator, you apply for the loan with them. It goes to a processor to gather up all the details, and then it goes to an underwriter. So first step, that approval process, is the borrower's analysis, where they're looking at their credit history and their credit score. If it's two borrowers, they're going to look at both of their scores, and maybe one is better than the other, so much so that it'd be best if that one that doesn't have great credit is not even on the loan at all. So they're going to look and figure out the best way there. They're going to consider the adequacy of income. They're going to look at those ratios. Housing expense compared to gross monthly income, and also housing plus recurring debt compared to gross monthly income, to make sure they can keep paying the payment. They can afford it in their budget. And then analysis of the property itself, both with appraisal to see what it's truly worth, because list price is only wish price. And yes, okay, in a market like this, we went under contract and the buyer was willing to pay more than asking price, but that still doesn't mean it's worth it. Just because a buyer got excited, why do buyers want to buy residential property? Emotion is a big deciding factor when it's residential. Therefore, between that and maybe they lost 3 in a row before they found this house, they're determined to win at all costs. And so they make an offer that is so much above asking that it's actually not supported by the comps, by the comparable sales that have happened recently. And that's what the appraisal is there for. Let's make sure that all of this is in check. Because if that buyer was paying cash, sure, pay 5 times more than it's worth for all we care. It's your money. But the minute they're using someone else's money, the lender's like, wait a minute, I can appreciate you're real excited to own this, but we're not going to loan you 90% on something that's 2 times more than it's really worth. So therefore, what is it worth? We're not going to believe the brokers either. In fact, they're not even allowed. Even if the lender was willing to get a broker price opinion of the value, they're not allowed to. When they're making a new loan based upon something, they need it to be based on an actual appraisal, not on what a real estate broker says it's worth. Even if it weren't one of the brokers involved in the transaction, it's got to be an appraisal for an actual new loan. And what else they do is check the title. Let's make sure there's no clouds on the title because of a fence over the line or a building or the house, maybe. There was a case I heard about once upon a time where they bought the property. Come to find out, the well was not on the property because they never had a survey and discovered it. The neighbor owned the well, which meant the new buyer had to drill their own well. And wouldn't you know it, when it rains, it pours. Not only did they have to drill their own well, it was one of those that had to go extra deep into the earth to find a decent level rate of water. It was like $60,000 to dig the well. Guess what that new buyer said? Oh, that's no big deal. Sure, I'll do it. No, they said, hey, real estate broker that helped me buy this, why didn't you tell me to get a survey? I would have avoided all this problem, and we would have discovered there was no well on this property. Guess who now gets to pay for the well with every commission check? They worked something out. That agent didn't have to come 60,000 out of pocket, but they do eventually. They had to do some sort of a payment plan. That's tough. Not to speak of the inevitable, I'm sure, disciplinary component. I'm sure they turned them in as well. So surveys are important. They tend to be put to the back burner. Surveys are there to discover lots of things: flood insurance, the need for, is it a floodplain, therefore needs insurance, but also encumbrances, title investigation reveals lien issues. So that's part of the property analysis too. With that loan application process, the biggest, probably the first question a borrower asks a lender is, what's the rate? And rates, especially this year, is a great example. This last year or two, rates moving pretty crazy, pretty dramatically. A year ago, they were hovering around 3, and we've doubled that. Even January of 21, they dipped down to 2 3/4. I saw a Facebook post this morning, and somebody's like, just enjoying the rate I locked in last year at 2.76. They're just rubbing it in to everybody else who's getting one now for 7. So how do we go when we first start looking for a house and we think, okay, I want to look for a house. I've talked to the lender about what I can afford. What if it takes me a couple of months to actually buy the house? The rates are at 3.5 now, but what happens if they go to 4 by then? If the person is shopping close to the absolute most they can afford, that could disqualify them from affording the house. First of all, they shouldn't probably be there. If you are maxing out the most you can possibly afford, I like to tell borrowers, potential buyer clients, look, guys, just think about this. If the lender says you can afford 500, maybe we shouldn't be looking at $500,000 houses. Maybe we should be looking at $400,000 houses so that we, first of all, have room to make offers over asking price if we need to in order to win, because that's the way the market has been the last couple of years. And second, don't just rely on what the lender tells you. They're just telling you what they're trained to tell you. Here's what your current numbers support. But they don't know that it is your dream to go to Disney next year. It is your dream to put 3 kids through college, whatever. Pay off your debt. Therefore, what you afford on paper is different than what your budget for your own personal goals says. So maybe you should be backing down to allow for things that the lender doesn't really care about. They don't care about your need to put the kid through school so much. They just are trained to tell you, here's what your current income and debt will allow you to buy. And I like to tell people early, that may not be what you want to buy, because first of all, it's true. Second of all, they're like, oh, wow, he's not just trying to sell me the biggest house he can get the commission on. That's what they think we're all trying to do, is make the commission on the biggest number we can talk them into buying. The first time you break through and help them understand that is not how you work, that's when you have an agent or a client that will stick with you, a client that's going to trust you, right? Because that's really what it should be about. Don't just help them buy the biggest thing you can squeeze them, talk them into buying. Help them understand how it fits into their life and their budget and their future hopes and dreams. What that's going to do is turn them into a client that comes back and carries you along with them. He helped me get into that first one and stay well within my ability. Then I grew and grew, and now we're selling that one. We're going to buy the next one. We're going to sell that one. We're going to buy the next one. So it also helps down the road it's about the relationship, not the transaction. Don't squeeze every bit of juice out of every transaction at the expense of the client. Sometimes that means you take a little less. In fact, what I like to do when I first meet somebody is poke apart the houses we're looking at. I want to make sure that they don't think I'm trying to talk. And it may be it's not a great sales method, right? A sales trainer would probably say, what are you here for? To feel good and make friends, or to make money? Well, I think I can do both. I don't have to make every possible dime out of somebody and make them feel like I'm squeezing them. So I'm first and foremost here to make and retain a client forever, right? If they feel like you're trying to squeeze them, that's not going to happen. So when you start the process, we can lock the rate in. The lender will say, we will honor this rate. we'll do a rate lock because rates fluctuate. So you can be assured that the rate I'm quoting you today is going to be the rate you write it at when you go under contract and when you close, I should say. The issue with the rate lock is they don't last forever. And let's say the rate lock is for 30 days and now it's a day before closing and you get the news that for some reason the closing is going to have to be delayed 2 more weeks. One of the first questions you ask when you find out the closing or the settlement will be delayed is, let's check with the lender and see when the rate lock expires. That might be a big factor in what somebody wants to choose to do. Because if the rate lock expires, they're going to have to pay to get the lender to honor that rate that it was locked at once it is expired, or they're going to have to go up to the new rate. So maybe they don't want to end up allowing this delay. Maybe we need to really hurry up and try to get this delay to happen to not be necessary because we're locking the rate at a current market rate. Involves a fee. Sometimes there's a rate lock extension fee. Maybe it's because the agent didn't do something right that the delay happened. And now the agent needs to pay to extend that rate lock. Could be. We're talking a couple $100, maybe. Depends on the situation. Ideally, a borrower should get pre-approved before submitting an offer. In this kind of market, absolutely, I doubt many sellers will even consider your offer unless you have a pre-approval letter from a bank. It's just a good idea regardless. It's just almost absolutely necessary now because they have so many to pick from. They don't need to deal with somebody that doesn't have enough of their act together to show proof that they are going to be able to afford it. What is this moment of loan application? It's considered when the lender receives the address the person has applied for the loan. Loan application occurs when the lender receives the address. So that's the date that triggers things. Loan application is an important date, sort of like when the contract was signed. That was the effective date. Loan application date is important because the lender has a requirement to disclose the loan information in writing to the borrower within 3 days of loan application. Write that one down. Within 3 days of loan application, lender has to provide the loan estimate, the LE. That's what it's called. The document is called the LE, loan estimate. It's an official document. It is required from any and all lenders. They all have to put it in the same format because up until 2008, they had their own version. Back then, they called it a good faith estimate. And it oftentimes it was hard to find all the pertinent information. They really leaned on us brokers to help them understand one loan from another. And maybe it was only until you dug into the 15th page that you saw, yeah, that rate looks really low compared to the others because they're charging you 2 discount points and those other ones are not. Now, with the loan estimate, it's got to show all of those pertinent things very clearly and in the same place. It's the same looking document for every lender. It's much easier for a borrower to compare apples to apples, so to speak. Fast forward to closing time, and that loan estimate needs to be, you take those same numbers, that same information disclosure, and put it in another document down the road. Within 3 days before the closing or the settlement, the lender has to provide a closing disclosure to the borrower. 3 days again. There's that 3 days. We keep seeing 3 days. So up front at loan application, lender has to give borrower the loan estimate, showing what all those values are going to be. And then fast forward to the end point. Within 3 days before closing, lender has to show in the form of a closing disclosure or CD. Closing disclosure looks very similar to the loan estimate. It has some extra stuff too, but they'll show you, look how well we did. Back when we started this process, we told you the rate was going to be this, and it is. The fees for this are going to be that, and they were, or maybe we were a little bit over, and we'll explain that. So it's just full disclosure. That's why loan application is important. If they deny the loan, like anytime you apply for credit, whether it's a credit card or Best Buy or car or motorcycle, anytime they deny you credit, they have to tell you why in writing. And you'll get a letter in the mail saying, here's why we turned you down. you might find out immediately that they turned you down. But in this case, for a home loan, they'll probably find that out closer to the settlement point, and they will tell them, provide it in form of a written letter. This whole loan process was done wrong. There were a lot of improper treatment of borrowers done along the way. And so there are things in place to protect against that. There's the Truth in Lending Act. And within it, there are a couple of provisions. RESPA, here we are, we're deep in the world of the acronyms. So one of my favorite acronyms is something, I'll mention it in a minute. I won't tell you that now. I won't confuse you. RESPA stands for Real Estate Settlement Procedures Act. It is the legislation that says how we're supposed to handle settlement in real estate. And it's mainly there to protect them against lenders and agents too. There's some stuff that we as brokers are limited in doing that fall under RESPA. Mainly, if we make money from somewhere, we have to disclose it. We can't be sneakily making money. RESPA protects the consumer from abusive real estate practices. There's a regulation within it called Regulation Z. All the fees associated with the loan must be disclosed. That's part of that LECD process, the loan estimate matching up with the CD down the road. That's under Regulation Z. The lender has to tell them full disclosure. You can't throw in something. You can't say, yeah, your rate is only 5% instead of 6% and not explain why, that it's because there's 5 discount points they're going to have to pay up front. It also regulates what we're allowed to do in our advertising. We as brokers, as well as lenders, but we as brokers are limited under this too. What do you find to be an effective ad if it's a high ticket item like a car? What do you see in car ads that they use commonly to help you maybe get over the fact that it's a $50,000 car? Is it easier? Would they rather you think of it as a $50,000 car or as you're getting to it. Yeah, the rate, but also what is the rate affecting? They'd rather let's talk about payments, right? That last person you talked to on the car deal is the finance person, also known as the last salesperson, right? They talk you into the undercoat. They talk you into the extra warranty. They try to talk you into, hey, and then the back and forth in the negotiating, that car salesman person says, my manager says this or that. And they say, you know what payment do you want? Because they know they can fudge with the other numbers to benefit them, but still give you the payment that you want. Oh yeah, okay, we'll give you this interest rate and this payment, but it's a 60-month loan instead of a 48-month loan. Is that going to work? And you focus so much on the payment, you're like, sure, I'm thinking monthly. It can fit in the monthly budget. Oh, wait a minute. Did I just pay $5,000 more for this car because it's going to be an extra year that I'm going to be paying this payment, right? So it's effective in real estate advertising too. Agents sometimes will say you could own this house for $1,200 a month. And in a market where 2-bedroom homes are renting for $1,800 a month or $2,000, might be nice to show that. So you could be the owner of a 3-bedroom home for $1,200 a month. Well, that is what's called a trigger term. The minute you use a trigger term in your advertising, you've got to give them the scoop. You've got to give them the details. The minute you choose to use a trigger term in your advertising, you have to tell them how that $1,200 is possible. Oh, it's possible because you're going to have to pay $12,000 to buy the rate down so that the payment can end up being $1,200. Otherwise, it would be $2,000. So trigger terms are specific numbers related to the loan. All the terms of the credit and the payment and the duration of the payment have to be disclosed. If the test question asks you, are you allowed to use a trigger term in your advertising? The answer is yes, you are, but that triggers the requirement to disclose all the other terms of the loan too. So it's not that trigger terms aren't allowed, it's that it's an all or none situation. You can't just tell them a sexy payment and not explain that that's with this rate, this term, this many loans, this much money. You got to give them the full scoop. And here's what those trigger terms are. If you advertise with an interest rate, that triggers the requirement to tell them what the finance charges are going to be, the number and amount of payments, and the total amount financed. If you advertise any of these things, it requires that you disclose all of these things. That's the fine print. On the car ad, that's the guy talking fast at the end, right before the next commercial. That's the fine print, disclosing all of these things. And we as brokers can do that. We can certainly say, you could be in this home for $1,200 a month, but make sure in that ad you disclose with this interest rate, with this amount borrowed, with this number of payments, etc. So trigger terms are allowed, but it's all or none. Got to tell them the whole story. It's just the loan terms, though. If the ad, particularly let's think about maybe a builder. Builders run ads on things. If you promise seller paying the buyer's closing costs, or HOA dues being paid, or credit report fee is free, these are not trigger terms. So the test question can be kind of seem tricky. Don't let them lead you down a path. If you see some mention of seller paid closing costs, free HOA dues, that has nothing to do with the payment itself, right? So therefore, these are not trigger terms. You can advertise seller will pay all the buyer's closing costs and not have to disclose the payment or the interest rate. And keeping it generic is okay too. You can advertise no down payment, low down payment, no payments, low payments, things like that. These are not trigger terms. It's just when you get specific about payment, number of payments, total loan amount, that's when it's a trigger term. There's something called the Fair Credit Reporting Act, legislation in place to keep that consumer protected. It sets standards for credit reporting agencies to follow. It establishes rights of consumers to see their credit report and to be able to correct any errors. You have the right to a free credit report once a year. And retaining the record, the negative information that might pop up on a credit report is probably going to stay there for 7 years. The worst ones, bankruptcy and foreclosure, probably going to be longer, going to be 10 years. That's under the Fair Credit Reporting Act. In a little while, another chapter, we're going to learn about the equal housing provisions, the federal fair housing categories. Well, there's one provision for that lenders have to follow too. It's called the Equal Credit Opportunity Act. Let's make sure we're giving credit to people that's not based upon certain protected classes or denying credit to people based on certain protected classes. And 3 of them are added to a lender's requirement. A lender cannot deny somebody credit because of their age. Think about that for a second. Mortgage lender sitting there, and some person comes in who is, as they look at their license and do whatever they do to take application for the loan, they find out that person is 98 years old and they want to take out a 30-year mortgage. They cannot deny them the mortgage based on their age under the Equal Credit Opportunity Act. They also can't deny them based on their marital status or whether or not they're receiving public assistance income. So these 3 things are on the lender's shoulders that they're not able to deny credit based upon. 3 protected classes. Just as a reminder, as a recap, as we get out of Chapter 11, Federal Reserve is there to control the money supply, keep the economy stable. Primary market is making loans to consumers. The secondary market is packaging and selling those back and forth to fund more loans being made possible in the primary market. The market participants on the secondary level are Fannie Mae, Freddie Mac, and Ginnie Mae. And then we learned about conventional loans, which are not government guaranteed, FHA loans, which are insured by the government. There it is. That's all there is on this slide if you want to cap that. And VA loans, which are guaranteed by the government. And then RESPA protects consumers in residential loans. Regulation Z says the terms of the loan must be disclosed. Can't hide them. Apples to apples comparison. If you disclose one trigger term, you must disclose all the trigger terms. They are numbers related to the loan itself. They do not include things like closing costs. That is not a trigger term. And there's protected classes the lender has to honor, and that is age, marital status, and public assistance income. And that is 11. That is, let's look at 12. More math to come, but in 12, it's daily. It's that one of those categories that is a daily thing you need to be good at, because this is where the money comes from, right? This is what everybody's doing this for. Every participant, you, buyer, seller, other agent, firm, it's all about the closing. That is the success. That is the finish line that gets people paid and gets people keys. Your level 1 is not much. A lot more of it is level 3 analysis, or level 2 and 3. So RESPA, what is it? Real Estate Settlement Procedures Act. We'll touch on that. And then a lot of the other stuff is things you need to have a pretty good working knowledge of. The procedures before closing, before closing, and then the actual closing procedures themselves, the settlement statement, which involves the closing disclosure. That is the closing disclosure. The broker's responsibilities. When we get that settlement statement, we as brokers, we are held responsible for making sure some of that information is right. Not all of it is our responsibility, but some of it is. We'll talk about it. And then math. Okay. If you could turn this off right now, some of you would have probably done so when I just said math. We're going to talk about some prorations, because some of the expenses involved in a closing need to be shared by both parties, like taxes, property taxes. Because if, what is it today? It is the 28th of September. If I'm selling a house and we're closing today, and I'm selling it to you, I, the owner, live there from January 1st to September 28th. Therefore, I should pay the taxes that cover those days. You should pay the taxes that cover tomorrow through the end of the year. So that is what we're talking about, is one example of prorations. We're prorating the full yearly tax bill so that the seller's paying whichever part of it that they are the owner, and the buyer's paying whichever part of it that they're going to be the owner for that given year. There are some other prorations we'll talk about. The rest of the calculations are more, not all prorations, but more things like who's paying for what. Buyer and seller, debits and credits. The pre-closing procedures, I love. I don't watch it much, but when I watch HGTV, I'm just rolling my eyes the whole time, because when they're starting to pop champagne bottles because they went under contract, I'm like, do you know how many things could go wrong between now? The longer you're in the business, I think sometimes the more jaded you become. I'm not celebrating until check is cleared. Check is in, not even the check from the attorney, because that one has the firm's name on it. I'm going to turn that into the firm and get my check. Then they'll make sure the bank account has the money in it and I actually have it in my possession. Now I might think about celebrating. But let's go ahead and get busy with finding the next one, right? There's a lot of stuff to do during that under contract period. What is the reason we're doing this closing? We're transferring title. We're getting it from the seller to the buyer in exchange for the money, or the fainting goats, or the cars and guitars and motorcycles, whatever the items of value are, probably money. Consideration, the purchase price from buyer to seller, in exchange for the deed or the title from seller to buyer. And all of those funds are calculated, figured up, and dispersed to the various parties. It might be that some of the money is given to the government for the taxes. Some of it's given to the insurance company for the insurance policies. Some of it is given to the the agents eventually for their commission. The seller gets a check for their proceeds. The buyer gets the keys. Sometimes the buyer gets money too. Best way of terminating the contract and the agency agreements is this one: full fulfillment of terms. That means a closing. That means people got keys and money. Recap of some vocabulary. The difference between settlement and closing: the settlement is the execution of documents, the signing of things to transfer the property, to deliver them to the attorney. It involves the people getting together and signing. The closing does not have the buyer and seller in attendance, because the closing is the attorney or paralegal recording the deed. Deed is recorded, and only at that point may the buyer get possession, usually, and the seller get their funds. However, with the party's permission, the seller might be willing to let the buyer go ahead and get the keys, or the buyer might be willing to go ahead and let the seller stay past the closing. One second. I'm still here. Wait. Oh, there it is. There we go. Okay. And we're back. There we go. So the difference between settlement and closing is people versus paper, back from Unit 10. The key, officially the keys, the possession should be given once the seller gets their money. And if provisions need to be made otherwise, they can be, but don't forget the insurance component. Let's make sure the insurance coverage is in place if a party is becoming a tenant, basically. That whole due diligence process is that time period during which the buyer can make sure they still want to buy it, do their inspections, do whatever it is they need to do to figure out, should I go through with this or not? And that's when they can choose to either terminate or proceed by that due diligence deadline, because that's going to be the least expensive point to decide. Otherwise, they're going to have to also lose the earnest money if they decide after due diligence period. It's all about that time is of the essence, 5 p.m. on the date put in the blank. During that due diligence period, the buyer is making lots of choices. It is mostly in the hands of the selling side, the buyer's side, because the buyer chooses usually the closing attorney. The attorney fees, though, are paid, some fees paid by the buyer, some fees paid by the seller, but the buyer chooses who it's going to be. The buyer has chosen the lender. The buyer picks the inspectors. Some of this is at the direction and guidance and suggestion of the agent, of course. The buyer is the one who picks and pays for the surveyor, I should say it that way. Then the buyer is going to be selecting the insurance provider for the homeowner's insurance. Don't forget to do that, by the way. Some people don't think about the insurance until like a week of closing, and it's 2 or 3 weeks after due diligence deadline. Then they find out it's going to be more expensive than they thought, than they would have ever had a reason to think it would be for the insurance policy. There is no loan contingency, as another review here. No loan contingency built into the offer to purchase. If the buyer can't get their money, they still can walk away, but they're going to walk away from the due diligence money, which they walked away from on day one. They're also going to lose the earnest money because there's no loan contingency automatically built into the offer to purchase to T. And also, if they can't get their financing, they need to give written notice of termination. Ideally, they find that out during the due diligence period, but might be hard to do. Depends on how much time the lender needs to get full loan approval. But if they are able to back out because of no loan approval, they would need to do so by 5 p.m. on that due diligence date in order to not have to lose the earnest money too. There's lots of things the buyer's looking at and you as their buyer agent are driving this boat, and you're looking at investigation of the property, the insurance, the appraisal, zoning requirements. You might have done that earlier already. Government regulations, flood hazard zones, utilities, street access, easements, streets and roads, public or private. Is there a fuel tank on the property, like an underground fuel storage tank, which maybe is no longer used or might have rusted through and leached fuel oil into the soil? A lot of OI words in that one. The problem with that is now the EPA cares about it. Let's find that out before the buyer owns it, because it can be an expensive problem to solve. Septic system, wood destroying insects, termites, could be carpenter bees, powder post beetles, lots of things eat wood. Survey itself, anything and everything. And again, let's figure that out. Let's build enough due diligence period into the transaction to find these things out. That one about the termites, which we should call it the wood destroying insects. There's a termite letter, you might hear it be called Wood Destroying Insect Report, WDIR. What is it reporting? It's saying that on this day, there was nothing that I could see with my naked eye. The wood destroying insect inspector. They're saying, I'm not going to pull the kitchen cabinets away from the wall and look back there. I'm not going to send a little mini camera in every corner and crevice of the house and guarantee that there's no bugs anywhere that are eating wood. It's just what I can walk around and look at and see. It could even be that they go in the garage. Anybody have seen a garage? It's probably not your garage. I'm sure yours is organized. But have you ever seen a friend's garage where there's stuff everywhere? It's completely packed, floor to ceiling, walls covered. If that inspector gets there check for wood destroying insects, and that's the case, they're not pulling the toolbox away from the wall and looking down there at the baseboard. They're just going to look and see what they can see. So if you're the buyer agent and you're concerned about termites, or more specifically your buyer is, maybe that's a provision you put in to negotiate. Hey, seller, could you get some stuff pulled away from the walls so the termite person can see everything? Because there's been plenty of cases where they gave a clear letter. They said, look, I don't see anything. But then upon move out, those walls were uncovered. And what you'll see is in the baseboard molding, the bottom of the wall, sometimes it looks a little weird and shimmery and wavery, and you poke it with a screwdriver and it goes in straight on in. You wouldn't do that as a broker. The inspector would do that as their natural course of the inspection. And that's a bad time to find out on morning of closing, when you're there for the walkthrough and oops, wait a minute, couldn't see that, therefore we got a clear termite letter. So it does not report that there's absolutely guaranteed no termites, no wood destroying insects. It does report that from what I can see from my naked eye, looks okay. When do the negotiations of repairs need to be completed? Negotiations of repairs. Oh, looks like it's going to need $7,000 of work. Looks like it needs a termite treatment, spray, treat the whole house, cost $1,200. When do we need to work that out between parties? Within what time frame? Your buyer would have whatever inspections they want done. You'd get the inspection reports. You both read them. You talk to them about it, and you both agree, what are we going to ask the seller to fix? We just want that seller to have in writing and sign off saying that, promise I'll fix it by this date. What date is it? There it is, Shane. The due diligence deadline. The negotiations can be completed within the due diligence deadline. Once you have it all in writing, the written promise by seller to fix it, they have from then until closing to fix it. So the fixing can be done later. Negotiations completed by end of due diligence, repairs completed before settlement. What can the seller do when the buyer asks them to fix something? Well, remember from our question last time, every transaction is as is. The contract is written to say this is an as is contract. That does not mean you can't ask for something to be fixed. By the way, even if it's a bank-owned property and they say this is as is, we're not fixing anything, I still ask. Because if it's a big enough deal, if that means they want to keep this transaction going and go ahead and close, that's probably quicker and cheaper for them to hang on to your buyer and fix something than to put it back on the market and get another buyer, especially in a more neutral market. And I've had success with them replacing $1,000 part on a water heater, a tankless water heater on a new construction house that the builder had gone belly up on. And it was a 3-year-old new construction house that never had an owner because the builder went out of business and lost it to foreclosure. $1.5 million house now being bought for $800,000 because it's a foreclosure. And it, of course, sat there without anything being used. And so some things were in disrepair. And even though they said this is as is, they fixed some of that stuff because on an $800,000 sale, yeah, okay, we'll throw $1,000 at it to get it closed. So keep asking. The contract is built to be as is, but the seller's options are what the seller could not do if your buyer said, I want you to fix this and that and the other. The seller could not say, well, I'm mad that you even asked, where this deal is over. I'm walking. You can't buy it. They can't kill the deal over it. The seller, the worst they can do is say, no, not fixing it. Or, yes, I'll fix it. Or let's meet somewhere in the middle. Let's either, instead of the $4,000 for the septic tank repair, I'll give you $2,000. And you just have to come up with $2,000 of your own. And as long as the lender doesn't care about whatever the item might be, sometimes they mostly don't know about the repair stuff or really care, but the parties agree or come to some agreement with amongst themselves. And that's what you and the other broker are doing. You're negotiating that process. The final walkthrough. When should the final walkthrough be done? When do you think we do the final walkthrough before settlement? It's definitely done before settlement, but how much before settlement? It can be done on the way to the attorney's office. And some people do that. Some people say, we're closing at 11. Let's meet at the property at 8 or 8:30, and we'll make sure all the repairs were done then too. The problem with that is, if for some reason, either because the seller legitimately couldn't get things fixed and didn't know they weren't fixed because they put someone else in charge, or because they are hoping that the buyer is going to just go ahead and close anyway, and maybe if we don't fix it and they don't find out about it until 2 hours before closing, they'll just go on and not require us. Terrible, right? But it could happen. That's why, as a broker, I will, as soon as I find out things were fixed, and even if my client doesn't have time to go with me, I'm going. And Jennifer has a great suggestion. A week before, 3 or 4 days before, let's have it so that we can't end up with a seller saying, oh gosh, I'd love to get it fixed. I thought it was. So sorry. Now I guess, it's an hour before closing. You don't want to hold up the closing over this. That is the ultimate buyer's leverage. The buyer's only leverage when something's not fixed is to not close. But the reason they do go ahead and close is because they have stuff on a moving truck. They're going to have to pay 2 moving jobs now to take it off in a storage and put it back on for when we are able to close. And all of these moving parts, all this momentum built up, they don't want to stop. But the seller knows that. Some savvy sellers that might be trying to take advantage might know that. So final walkthrough needs to be before closing, and verify repairs are fixed as soon as you possibly can, so there's room to say to the seller's agent, oh yeah, some of the stuff's not fixed. Well, good thing we've got 3 more days. Hopefully you guys can get that squared away so that we can close. Throw that little passive-aggressive hint in there so that we can close. In other words, you better fix it or we ain't closing, whether it's the buyer's choice eventually or not. Let's make sure that they know. We're watching. Get it right. You should have had it done. You told me it was already fixed. So you're looking for things that should have been fixed. And then I jokingly say that due diligence period should be called the earnest money period, because that's really the money that it depends upon, right? If we back out, if the buyer backs out after due diligence deadline, it's the earnest money they're going to lose. They've already lost and given away the due diligence money. What are the seller's issues in this transaction with these repairs. And well, the whole transaction, the seller, does the buyer have money? Either their own money to pay cash or the down payment plus the money being borrowed? And were all the contract terms completed as required? That's what the seller and the seller's side, the broker, the listing agent is looking for. Are all of these things done? The closing attorney, settlement agent, attorney, is doing a title search. They are gathering information. They will send out an information sheet to both brokers, the seller's agent and the buyer's agent. And they'll say, send us this following information. Some of it is kind of confidential. Some of it, like on the seller's side, they want to know the seller's social security numbers. They want to know the loan numbers so that they, the closing attorney, can look up the final payoff. They're going to order the final payoff and contact that seller's lender and say, hey, what are they going to owe as of this settlement date so that we can send you the final payoff to pay off this loan. They don't want that to come from the seller directly. Even if the seller is very organized and on top of things and say, I already got the payoff, I'll just send it to the attorney. No, they're not going to go with yours. They're going to get it straight from the seller's lender. That's why they need your social, and they need the loan number and the phone number for the loan company, the lender. It's the attorney that draws all that, gets that from the lender. You, the agent, kind of help facilitate getting the information over. But in the interest of this whole email fraud, wire fraud stuff, let's be careful as brokers of what we are the middle people for. We don't want to be the middleman for every single thing. I would rather not get my client's social security number and loan number and hand it to the attorney. I'd rather tell my client, you contact the attorney yourself directly and hand over those pieces of information. The rest of it I'll do. I can tell them that I'm the agent. I can tell them my commission split. I can tell them names and numbers and phone numbers and emails, but the pertinent financial sort of sensitive information, that should come straight from you to them. And I even had one borrower who was in the business of fraud with a bank. Therefore, they were so paranoid that they actually drove to the attorney's office and looked the paralegal in the eye and gave them their social security number that way. They didn't want to do any sort of faxing, emailing, or phone calling with voice. That's just the way they wanted to do it. I was out of it. I said, here's how this works. You do you. The attorney is going to be the source for some other things too. They're going to check the deed. They're going to write the deed based on what they saw in the contract. Any sort of leases, provided it's an investment property, the mortgage payoff again, personal property bill of sale. This is a frequent one. Somebody wants to buy a house. Maybe it has a pool and there's pool furniture and chemicals and maybe some tables and chairs and things that are personal property. And they write all of that in the contract. This is for the house plus everything in the blank. And they're writing tables and chairs and the L-shaped desk that's huge and the sectional couch. And then what will happen next is the buyer agent will call you, the listing agent, and they'll say the lender, when we sent them the contract, they don't like all this extra personal property in the contract. Because what are you buying? A house or a bunch of personal property with a house around it? Basically, the lender wants to see a very small amount of stuff mentioned as personal property. They would allow a washer and dryer, maybe a refrigerator. But they don't want to see a bunch of furniture and anything significantly beyond that. They will require you to take that out of the contract. The lender will require that to not be in the contract. What will happen, though, is how do the parties guarantee that the items are actually going to be left, right? If they want them just to leave them behind at closing. So that's where a bill of sale comes in. It's a way to have a legal document that acknowledges the personal property purchase, maybe even for $1, because it's really part of the purchase of real estate, but we're leaving it behind and we'll have something in hand to prove that that was a sale between the parties. And the attorney would be a good resource to get a generic bill of sale, or maybe write one custom, depending on what the stuff is and how much of it. They're also going to make sure, what is this last one talking about? What is a 2-word phrase? I'll even give you one of the words, lien. What kind of lien are we talking about when I say no unpaid bills in the last 120 days? Thank you. That was quick. Good job. Who else? Who's watching the chat? Yeah. any vendors, roofer, electrician, plumber that didn't get paid can put a lien, a mechanic's lien against the property. They're looking for those and all the other liens too. In fact, that's why we say the closing is when deed is recorded, but one of the things they do before they record the deed is check one more time to see if any other liens have been added. Maybe another vendor put a mechanic's lien in the last hour even. So before we record the deed saying that everything is done, let's make sure there are no liens as of this moment. There's an agent an attorney in Cornelius. I don't know if he still does this, but his name is Yates Faison. Has been in it forever, and he still does not do electronic recording. He still goes to the courthouse and does it in person because he said there's still a tiny chance that a lien could slip in there. I want it to be instant, guaranteed, no question. I have a feeling that I heard him say that probably 2019. I have a feeling the following year might have required him to change his procedure because I doubt anything was done recording wise in person at that point. Document preparation. The closing attorney, the settlement attorney is doing some stuff. Let's go ahead and have our break. Let's come back at 11. We'll come back in 10 minutes, whatever that ends up being. Welcome back. There we go. Can you hear me okay? Good. All righty. By the way, guys, we are live streaming straight to the YouTube channel, so it's like, it blows my mind how this is possible. But as soon as the class is over, it's up. I'm not having to take a couple of hours. I'm not doing any real post editing. All I do is within YouTube, take out the breaks if I can, because it lets me do that. Chop a few frames out for that. But besides that, it's there. So I think I still need to put maybe one or two classes up from last week or two. But besides that, the whole class should be up there. If you missed something, let me know if I overlooked something, but I think it's all there almost. Okay, document preparation. The attorney is doing a lot of things. Paralegal actually is doing a lot of things. The attorney is showing up at the closing and saying, here, sign here. But the paralegal has done most of this stuff along the way. They're ultimately looking for what's called a loan package. Once the lender has approved the loan, they will put everything, all the blanks are filled, all the 2 inches worth of documents are filled out properly, and they will send the loan package to the attorney. And that's the question everybody's asking the attorney. Getting up to the settlement date, did you get the loan package yet? That's a huge email attachment that they print out so that it can be signed. Sometimes things are signed electronically. And it also involves the title insurance policy, the title search, and the title insurance policy being created. The property insurance needs to be given to the attorney. So the attorney will send those information sheets out to both the listing agent and the buyer's agent, and they'll say, send us this information. Who are they using for insurance? They'll ask the buyer agent that. And you may not know that because they didn't really need you to shop for that, perhaps. They don't really all the time ask you for it either. The buyer doesn't ask their agent, you, the buyer agent, but sometimes they do. Who do you recommend for insurance? I usually tell them, try your car insurance provider first. They might give you a group deal, package deal or something. Or if you know a good insurance agent you've met in your networking efforts, pass them along somebody good who's going to take good care of them, who's going to answer the phone and work through a problem. The wood destroying insect report, they want to make sure if you had that done, the lender doesn't necessarily require that anymore. They used to. But if they do, and the attorney will just have one done so that the parties can sign it as needed. Survey, if the buyer had one done, sometimes the attorney will say, do you want us to order the survey for you, and we'll just bill you at closing. So all of these things are buyer paid items, and many of these things are handled by the attorney. Don't forget the title insurance is that thing that has two policies involved. There's a borrower policy that the buyer, it covers their interest, which is the purchase price, the value, and it maintains that for the whole time they own it. It's a one-time thing. It's not a monthly payment. They pay it once at closing, and now you have title insurance. The borrower pays one policy for themselves, an owner's policy. They pay for another policy that benefits the lender, and that one drops off over time. With each payment, you have less of a loan balance, hopefully. And so you need less title insurance coverage because that loan is decreasing. The coverage is decreasing. Eventually, it'll go away. That coverage is not needed anymore because there's no lender anymore because you paid off the loan. Procedures. Title search is the attorney. They're doing that. They're investigating the title. They're going back through that grantor grantee index. And don't forget the Marketable Title Act. They only have to go back 30 years. They don't need to investigate past 30 years because it's all of that stuff that might have been a cloud on the title and a problem is considered not a problem. They just need to make sure it's clear back to 30 years. The attorney does the search. They issue an opinion, a preliminary opinion. Yep, looks good. It should be safe for you to cover it, Mr. Title Insurance Company. They make a title commitment based upon that attorney's opinion. Now it's covered. Now we have title insurance. closing, all of these things, the where, when, what time, is chosen by the buyer. Now, in real life, sometimes that is worked out between them. Sometimes in new construction, the builder will give the buyer an incentive to use the attorney that they like to use because that attorney knows their builder product really well and it's smoother. But they might give them some closing cost assistance in exchange for letting them use their own attorney. Something like that. But for your purposes in answering these questions, the buyer picks and pays a certain portion of the closing to the attorney. The larger, if there's two in this class, the attorney fees are probably going to be $800 to $1,000 for your information, but the attorney fees are paid by buyer. The only thing the attorney is doing for the seller is deed preparation for the most part. The buyer has picked the attorney, therefore whose allegiance is the attorney's, whose allegiance is it to? Who is the attorney's allegiance to? I'm going to get it out eventually. They owe it to the buyer because that's who's paying them. That's who picked them. But there is something the seller is going to have them do for them, and that is preparing the deed based on what was in the contract. That deed preparation fee we'll see in our problems, our calculations, tends to be a couple $100, $200 to $300, $400, $500. In real life, it's up to $400 or $500 now. Used to be $200 or $300 not too long ago. So deed preparation is a seller expense. Deed prep. Think of it as washing the car. You're going to wash the car. You're going to pay to wash the car so that you can sell it for the most money. You, the owner, the seller, having it washed. You're having the deed written so that you can sign it, because remember the grantor, the seller, is the only one who signs the deed. Therefore, you need to have that deed prepared to give over to the buyer, and therefore it's your expense as a seller. Seller pays for deed prep. Write that one down. Buyer picks the attorney, but the attorney does the little bit of work needed to be done for the seller, including deed preparation. Now, if a seller did have an attorney, maybe like prepaid legal or a relative that was one, seller might say to you, the broker, I got my own attorney. I'm going to have them do my stuff. And that's okay. You could say, okay, great. And what would happen behind the scenes is their attorney that they've picked would basically do the deed prep and send it over to the closing attorney with a bill, if they're charging, to be paid to them for having done the deed preparation. And the closing attorney doesn't care. That just means that's something they don't have to do. And they'll send the proper payment. They'll just bill the seller at closing and send that money over to the one who did the deed prep, the attorney who did do it. But the seller pays for it. The buyer pays the bulk of the attorney-related expenses, though, in real life and in the class. There are a couple of types of closings that happen. The one that we do is called a settlement meeting. We're getting together, people are signing, and then that becomes a closing when a deed's recorded. There's also something called an escrow. And if you watch HGTV Real Estate, they'll often say, close of escrow is in such and such time. That's not the way we do it. Escrow method involves an impartial third party. We don't do it that way here in North Carolina. Each party has an agent. The settlement attorney is working for the buyer for the most part. They do a little bit for the seller, but they represent the buyer. And because the buyer is getting a loan, they represent the lender too. So if there's a dispute and your seller client needs some legal advice, they shouldn't ask the closing attorney for that legal advice because that's not their attorney. They're specifically and very clearly on the buyer's and lender's side. Your seller should get some other attorney's advice if there's some kind of a arbitration or dispute or something going wrong. Does only an attorney, is it required that only an attorney does the settlement? And that answer is no. We allow for a non-attorney to actually say, hey, sign here, conduct the settlement meaning we're meeting in front of somebody that does not have a law degree, and that person is pointing to the various documents for the sellers and buyers to sign. And that is allowed. You can have a non-attorney conduct the settlement. Now, big fat caveat here. first of all, an attorney still had to do the preparation. So when you have a closing agent who is not an attorney, that just means it's a non-attorney who's pointing and showing them papers to sign. And I've had that happen with non-attorneys. We've met at an Asian restaurant. We sat there, we had food, and the buyer, my buyer client, their seller client, signed in front of this settlement agent who was not an attorney. And then another time, my seller had already bought a new construction home, so she already owned it and closed on the new house and had moved in. And then we had the closing on the one I helped her with to sell. And we had that one with a non-attorney, and they met at her new house, and we all met at her new house together, sat at her kitchen table amongst all the boxes she still had not unpacked, and signed stuff. And that person, non-attorney person, said, sign here and here and here, and here's this page. Now, inevitably, somebody, buyer or seller or agent, has a legal question. And if it's a non-attorney facilitating the settlement, they've got to have quick access to an attorney to ask the legal question. So they better be able to get an attorney on the line quick, or we're not having settlement. They can't just give an opinion or give an answer if they're not an attorney, but they can be the one that says sign here. So they are allowed to, in fact, a broker. One of the brokers could actually be, I don't suggest it. The real estate commission probably would say, let's just not. But who needs that in their life? But there are people who that's their living. I've done it where we met at a place and we're all just sitting there at the restaurant and we were waiting for them to come. They finally rolled up, the actual settlement person. Who's required to attend? The buyer and seller do not have to be there at the same time. And ever since 2020 and all that happened, they really stopped being there at the same time. In fact, I've had closings in the parking lot of the attorney's office. Don't even get out of the car. Let's just go there. And they don't even really, at that time, they didn't even want us agents come into the closing either. But we have a responsibility as brokers to make sure the settlement paperwork, the numbers, the calculations are correct. Some of them, not all of them, but some of them. And I was always there. And they would come out in the parking lot and stick the papers through the car window, full mask, everything, and say, sign here and here. But the parties don't have to be there. Back in the day, they were always there at the same table, staring at each other across the table. But that's not the case so much anymore. Sometimes they'll both get there at the same time. The buyer will stay in the waiting room. The seller will go in and sign first. Takes about 15 or 20 minutes as long as nobody asks too many questions. They're done and gone, and they leave. Buyer then comes in. The buyer's side takes longer, especially if it's a loan, because there's a lot more documents. 45 minutes, maybe even an hour. Again, how many questions are they asking? Depends on that. But they're not required to attend together. But here's the important part. For you, as a broker in this class, for the test, and in real life, even though there are some agents that do this and are lazy, the commission says if a broker does not attend closing, that is a violation of their fiduciary duties. What happens at closing? Fireworks, drama, cage match, jello fighting? No. It's hopefully very boring, hopefully very anticlimactic. If you did it right, all we're doing is formality, signing some documents, we're done, yawn, give me my money in a couple hours. But when things do go wrong, and I've had that happen, I'm sitting there, something's threatening to delay this whole thing, and I'm able to look up an answer or an email or something somebody sent at some time and provide the document right there on the spot, and now everything's back on track and we have a successful closing. Otherwise, it would not have closed today. Let's be there with all stuff in hand so that we can solve these problems, because that's really, hey, guess what? We do have value. We are sort of the gatekeepers and the record keepers, and we kind of knew the whole transaction, and we're able to, oh, no, that was done. Oh, you thought it was? No, here's proof. Here's the thing. What email can I send it to you? Paralegal, so you can give it to the attorney, right? We can solve problems and keep things on track. So we really should be there. The commission says so too. So two things are done for this during this closing procedure. Are the promises fulfilled? We're making sure they're fulfilled. And did the buyer's loan actually get funded and finalized? So at settlement, the buyer's signing 2 inches thick stack of papers. Once that is done, we are not giving out keys yet. Not allowed to give the keys, even if we have them in our pocket to be given eventually. We can't give the keys over unless provisions have been made. But besides other plans being made, we can't give them until we get notification that the deed has been recorded. Might mean that you come back and meet them at the house to give them the keys, because that's when you got word that the deed was recorded. So they signed the papers. Another one of these things to add to your list of things to tell them early in the process. Terrible idea to tell them, oops, might not have immediate access. Closing's at 11. You'll be signed by noon. What, you mean I can't let the movers start moving in at 12:15? No, you can't. And if it's not been recorded, I can't give you the keys. Let's go ahead and let them know that before they make moving plans, right? So, in the promise is fulfilled, the loan finalized, the papers are signed, the attorney, paralegal, sends them up to the lender contact, and they need to look everything over and make sure it's been done properly. Then they'll say they probably already sent the money, they funded the loan, it's just sitting in the attorney's escrow account. Then they call the paralegal and they say, okay, yep, everything looks good on our end. Go ahead and release the funds, record the deed, and then record and then release the funds. Now we're done. The North Carolina Good Funds Settlement Act says that the deed must be recorded before dispersing funds. That's what that means. But the parties could agree otherwise, but make sure everything is not the funds recorded. The parties could still move in, but the funds are not going to be dispersed until the deed has been recorded. That's absolute. Not getting any money until that deed is recorded. The very end, the attorney's checking the title one more time, checking for liens. Then they'll record the deed. They'll record the deed of trust. That is also public record. You could look that up, of your neighbors and friends and family. Seller's liens are paid at closing. They're all canceled. They've been paid, so now those liens are canceled out. The funds are dispersed to the seller. Eventually, the agents get their money same day, but usually their checks are picked up later. And the IRS wants to know about it. So the sale is reported to the IRS. That's some of the documentation that is signed as well. Oh, we got a lot of static. Anybody else hearing a lot of static? Sorry. Bear with me 1 second. Who can hear me? Okay, we all good? Is it better than it was? Okay, thank you. All right, the old turn it off and back on. The closing disclosure is an extension of the loan estimate. It is the thing that the loan estimate informs. It's informed by it when it's a loan. Closing disclosure shows what the seller and the buyer are getting. All of the funds are accounted for. Settlement agent, the attorney, disperses the funds from their trust account. All the money goes into the attorney's account, and the attorney writes the checks out of the account. And they deliver the closing disclosure to those who need it. An original is signed, a wet signature, actual pen to paper must be signed and given to various parties. There's several originals made. The lender wants one. Each agent usually gets one. Each party usually gets one. Okay, here's RESPA. The Real Estate Settlement Procedures Act was created in 1974 to say, hey, let's put some certain procedure in place for this. It's to protect consumers against predatory or abusive lending practices. It's to give accurate estimates for all the charges in a transaction. It's also there's a component in place to govern us as brokers. It's there to keep us brokers from getting kickbacks. We're not allowed to without disclosure. People have to know. In other words, if we tell somebody to use a lender and we're telling them to use that lender because that lender is going to give us $300, they would need to know that. We're not allowed to get kickbacks. We can't, and it's only fair that they know that we're referring an inspector to them, not because the inspector is going to do a great job, but because they're going to give us $50. That would be a problem. Or maybe just don't ever take those, right? How about that? Just give out recommendations because the person takes good care of clients. The RESPA also puts a restriction on how much the lender can collect and keep in the escrow accounts. Remember, many loans are paid with a PITI payment, principal, interest, but also taxes and insurance. You're sending your lender 1/12 of your taxes every month, 1/12 of your insurance every month. They're not sending that right back out to those places. They are putting those in their own escrow account in-house, and then when those bills come due once a year, they will pay them. That is still your money. It's being held by them. Now, a lender who's in the business of loaning money to people and making interest on loaned money, if they could get away with it, don't you think that they would love to make you put 10 years worth of taxes and insurance in the escrow account so they could draw interest on that? You bet. They would do that upside down and backwards and every day, but they're not allowed to. There's a limit restricted by RESPA that says, nope, only enough needed. You can't use this as an income method, guys. We're restricting the excessive escrow account deposits. Can only collect as much as needed to accomplish the goals of this borrower to pay those two bills. It's not a serious income revenue stream for you. RESPA Regulation X covers residential property, most of it, 1 to 4 unit properties. If it gets to 5 or more family properties, 5 unit, that's considered commercial. So 1 to 4, also single family homes, also condos and townhouses, and also all of these types of properties fall under the jurisdiction of RESPA guidelines and requirements. Also, everything financed with a federally related new loan. What is a federally related loan? I know what you're going to guess. I'll save the time. You're going to say FHA and VA, and that's a great guess. But since the Dodd-Frank Act came out, it kind of put the government in charge a little bit of even conventional loans to make sure people didn't abuse borrowers, make sure lenders didn't abuse borrowers. So even conventional loans for these purposes are considered federally related. In other words, conventional FHA and VA loans, all of them have to comply with RESPA guidelines, and even conventional are sort of technically considered federally related, not because they are insured or guaranteed by the government, but because there's sort of a government conservatorship they watch over to make sure they're doing it right so we don't run into another 2008 situation. The lender is required to give certain disclosures. One of them is that LE, the loan estimate, that says, here is what your costs are going to be. It's going to be on this line of this page, and they all look alike. They all look like this thing on the left. They also provide their borrower something called your home loan toolkit. You could pretty much sum that up into, hey, make your payment or you'll get foreclosed. It's tips and tricks and guidance to help make sure people understand and have a record. Yeah, we told you what you were doing. Oh, you can't make your payment? Well, we told you had to, or we could foreclose. They need to provide these things to the borrower within 3 days from loan application, from that point at which an address was given, an official loan application. lender's responsible for disclosure. Got to give that disclosure to the buyer within 3 days of loan application. The LE is 3 days after loan application. And then fast forward to the settlement day, they have to give the buyer the closing disclosure 3 days prior to settlement. In other words, if they give them the closing disclosure 3 days before Friday would be what? Thursday, Wednesday, Tuesday, Wednesday, Thursday, Friday. Yep. But then on Wednesday, they change the rate. Something significant changes like that. They would have to issue a new closing disclosure. They'd have to give them a new 3 days. We're not closing on Friday. That came out several years ago, and it freaked everybody out because so many times that it was such a typical occurrence in the industry that day of closing, a new disclosure would come out, a new CD, and the buyer only had like a couple hours to even see the new terms. Well, they decided that's just too much room for misbehavior. So need to give the buyer full disclosure, the CD, 3 days before settlement, even if that means we have to push settlement because we have to somehow change the disclosure and give them a new 3 days. They just learn to adapt to it. They just learn to do what they should have done to begin with. Hey, let's just give them what they need to know ASAP with plenty of time. And we all expected it to just result in disaster, but we all adopted, acclimated to it. The loan estimate form looks very much like the closing disclosure form. The fees and interest rate are disclosed in the same spots on both forms. It's formatted the same way, so it's very easy for the borrower to understand where everything is. They have already seen it on the loan estimate. Now they're seeing it on the disclosure, and they can say, yep, it lines up. They promised me it would be $250, and it actually turned out to be $230, so they're saving me money. And that's what the lender will try to do. They will try to give them the worst case scenario on the loan estimate so that they can show them on the closing disclosure that they did even better than that, lower than that. And the reason is this: the tolerances. There are 3 categories of loan estimate tolerances. Whatever that lender promises on the LE, they have to deliver in the closing disclosure. And if they don't, depending on which category it's in, they could end up having to pay the difference. So you better believe they got real good at it. They no longer give the rosy, unrealistic scenario on the loan estimate and then have no chance of delivering it on the CD. Back in the days before the loan estimate was a thing, when it was what was called a good faith estimate, before all of this new revision, they would give you the rosiest, unrealistic, oh yeah, it'll probably only be this. And then once the ball is rolling and the momentum is going so fast, oh, sorry, we forgot about this $800 extra thing. So that's the reason it's there, is to keep that from being a possibility. There are 3 categories. One of them is the no limit category. In other words, whatever the lender tells the borrower when they give them the loan estimate in the beginning upon application is exactly what it must be on the closing disclosure. And if not, the lender has to eat every bit of it, every bit of the overage. They've got to tell you exactly what those fees are going to be. So what are those fees that the lender is the most responsible for? Literally the fees that they're responsible for. What do they choose to charge? That category of fees is basically where the lender charges exactly what they charge, right? Actually, these are kind of in a reverse order from what I was thinking about. The $0 difference is what we're talking about now. The lender charges something, therefore they should honor that thing. So it's that last category, 0 difference, no difference in dollars at all. The lender charges for an origination fee, 1.5%. It better be 1.5% or lower when closing disclosure comes. And if it's more than they promised, the lender has to absorb it, pay for it themselves, because they have full control over what they choose to charge. Therefore, they can be held to that responsibility. Whatever you told them it was going to be better be what it actually is, exactly to the dollar. The 10% category there in the middle, that means that whatever the lender said that was going to be, if it's more than 10% higher on the final disclosure, final CD, then the lender has to absorb it. But up to 10%, the borrower is just kind of given fair warning. Look, we're going to do our best. We think these items are going to be this much, but they could go up to as much as 10% more than this. If they go beyond 10% more, then we'll pay for the overage beyond the 10%. Lenders, a lot of the ones I deal with, will do better than that even. They'll get real close, and they'll say, look, we saved you money. Well, no, you just estimated really close. You were better about giving them the fair idea of what things are going to cost. And then finally, the last category is this top one, no limits, meaning the lender is not held to any responsibility for these items. These items include things like the home inspection. The lender does not have anything to do with choosing who you want to use for inspections. They don't ask you to use a certain one. Therefore, the borrower picks those. Therefore, it's on the borrower's shoulders. If that inspection told you it was going to be 500, but it ends up being 900, the lender has nothing to do with this. Therefore, the lender is not held responsible for paying the difference. That's up to the borrower. So the no limit category are things the borrower chooses. The 10% category are things where the lender selects the provider or gives the borrower a choice from a list, but the lender had something to do with it. So therefore, if it ends up costing more than 10% over, lender will absorb it. And then the zero difference at the bottom, that's a lender fee. Therefore, they should honor exactly what they promise. Those tolerances are listed in the LE and the CD. And quite often, the lender will point out to the borrower on the closing disclosure, they'll have a talk with them before closing, maybe by email, maybe by phone. They'll say, look here at this tolerances, look how great we did for you. We told you it was going to be this, but we stayed well within the tolerances. So therefore, pat us on the back. Write us a good review. RESPA regulates business arrangements. They also regulate something called borrower credit for yield spread premiums. Oh boy. The only thing you need to know here is they're keeping the borrower from unexpected expenses and full disclosure of things. So they will do something called an aggregate adjustment on the closing statement. It says there's more money in that's allowed to be in, therefore we're going to give you back some money so that it complies with RESPA requirements. They put restrictions on the escrow account. We can only collect certain amount for the taxes and insurance escrows. And then RESPA requires that the loan servicing disclosures are utilized, loan estimate and closing disclosure. RESPA affects us as brokers too. It's not all about picking on the lender. And RESPA affects brokers by prohibiting the payment or receipt of kickbacks or referral fees for settlement services. And that includes tickets to the Panther games, even though those are probably not worth much right now. Sorry, Panthers. Or tickets to things, right? Little benefits and perks, anything that could be considered of value. We can't just get given a tickets to a game or a gift basket past a certain valuation as a kickback or referral fee. What are we as brokers required to do? What are our obligations when it comes to this closing disclosure? We're 3 days before closing. We get the closing disclosure. Our buyer gets it too. We need to look over this closing disclosure and go over it with them. We need to, first of all, verify that everything that came off of the contract is correct. Did the attorney read the contract right and put in the price properly? Put in the earnest money, the due diligence money amounts on there right? The commission, somehow or other, the agents never fail to make sure the commissions are correct. It's amazing. That commission math is just automatic. Credits in exchange for maybe repairs not being done. Sometimes seller will give buyer a credit. Whoever's given credits, it could be a broker. It could be that the buyer and seller were so mad at each other by the time the whole thing was over or close to it that nobody's paying for anything. And you're like, really? You're not going to pay for a $600 home warranty because of the principle of the thing? Wait a minute. I'm going to make $20,000 commission both parties are refusing because they're mad about paying for a thing because they're both like, oh, no, just not do. Okay, guess who's buying a warranty? I'll buy a warranty for everybody. You know, if it frees the closing up, let's look at the big picture. So we would need to confirm the accuracy. Who's paying for this? Oh, the broker? Okay, well, first of all, if it's for the buyer that they're paying something, let's make sure the lender's okay with that. Don't forget about that little nuance. But you, the broker, are responsible for making sure all of these things are on the disclosure. Any sort of invoices that are to be paid at closing, repairs, home warranty is a common one. You need to make sure that's included. So keep notes, keep a little journal of all the things that went on in the transaction, the upfront negotiation of the price, but then everything that happened during the due diligence period and the under contract period. Make some list so that you can real quickly compare it to the closing disclosure. Yep, got that, right? Anything we know about as brokers, we need to make sure is correctly reported on the closing disclosure. Why does it matter? If we don't do it right, RESPA carries a $10,000 fine per violation, up to 1 year imprisonment, and you could still be sued. Civil court, victim compensation, civil lawsuits, 3 times the damages. Because it's a RESPA violation, it's called treble the damages. Treble the damages because it's a RESPA violation. Normally the damages would be this much, well, times it by 3 because it's a RESPA related thing. We see that treble the damages again when it's a fair housing violation. Some of these things are just so extra important that we make the powers that be, say, well, the damages could be 3 times the normal amount because of the importance of the issue. Okay, here we go. Preparing the settlement statement. Now, the good news is in real life, you don't do this. The paralegal does it. They're plugging in numbers into an Excel type spreadsheet. It's doing the math automatically, but guess what? The math is only as good as who puts things in the right fields, right? So you still need to know it well enough to be able to double check. You will, in post-licensing 302, you will need to know how to do this math and put it into a blank closing disclosure. And I don't know why, but that's just the way it is. But once you get out of 302, you don't have to do it that way in real life. In real life, somebody's already done the math. You just need to check the math. But for our purposes, you need to do the math. First of all, what are the words? It's like your plain old checking account. Anybody have an accounting class, history, a degree in accounting, took an accounting class? What you learned that are debits and credits there don't help you here. It's more like what you're dealing with in a checking account for your own personal use. Is money coming in? Okay, that's a credit. Is money going out? That's a debit. That's all this is. What are the debits to the buyer? Things the buyer had to pay that we're settling up and reporting on the closing disclosure. What is a credit to the buyer? Things the buyer's getting. One credit to the buyer, if you think about it, is the loan amount. Ooh, wait a minute. Wait, but the buyer's having to make payment. Yeah, but at closing, for the buyer's side of the transaction, they're basically being given $350,000 loan amount, right? So that they can buy it and give it to the seller immediately and then pay it back over time. So we're talking about, what is it as of closing day? The loan amount is a credit to the buyer at closing day because they are benefiting from it so they can give it to the seller. We'll talk about this several times. Credits to the seller. Well, a big credit to the seller, the biggest one is the purchase price. Big fat credit to the seller. But then there are some debits to the seller, like excise tax and like the deed preparation, even though that's only $300 or $400. And prorations of things like taxes that we're about to dig into. So that's all we mean by debits and credits. Is money going in or going out? We do debits and credits for buyer, debits and credits for seller. And we're working our way down to the bottom of the page to say, what's the total amount of money the buyer needs to bring to closing? And then what is the total amount of money the seller's going to get? at closing, hopefully. Because in 2008, 9, 10, as a listing agent, it wasn't unusual to go to the listing appointment and say, okay, seller, so I see that you owe $150,000. Well, the house is only worth $153,000, and you got to pay my commission. You got to pay this and that and the other. So you're going to have to come to closing with a $7,000 check. Backup question. Do you have $7,000 to buy your way out of owning this house? So back then it was a little lopsided sometimes. We're not there anymore. It's rare to find a seller who's going to have to pay money to sell their house, but it could happen. So there's debits and credits, but then there's also prorations. And what a proration is when you're splitting a fee between the two sides. The buyer has to pay part of it. Let me say it this way. The buyer is paying it and giving that over to the seller side, or vice versa. Prorating it is one party giving that same amount of money to the other party. So it's a debit to one and a credit to the other. And it's the same amount of money. One side is giving the other an amount of money to make things fair because of the time of ownership, basically. A couple other terms you'll run across. The word accrued or accrual means something is due but not yet paid. Can be paid but not paid yet. Prepaid means you're paying for something in advance, like prepaid interest for discount points, for instance. We come back from break, we'll dig into these various buyer expenses, but real quick, let's look at the 30,000 foot view. Those are some but not all buyer expenses. These are some but not all seller expenses. The number of them is more on the buyer side. Doesn't mean that the total is going to be more necessarily, but let's dig into these when we come back. I'll see you in 10. Welcome back. Okay, there's people. Good. Here we are. Okay, buyer expenses, fees to the buyer, debits to the buyer, all ways to talk about this topic, all things you could hear it referred to as. What is the buyer paying for? What does the buyer have to pay for? Anything related to the loan, for one, because it's their loan that they're borrowing. Therefore, the lender says, then you pay for it. Then you pay these fees so that we set this thing up for you. Attorney fees. The bulk of the attorney fees are going to fall upon the buyer. Attorney fees include things like could be some FedEx, some overnight fees to send the loan package to the lender. Could be the title search. That's one of them. It's just a handful. And depending on how many loans, if any loans, they might charge the buyer less fees if it's a cash deal because they don't have to sort through all those loan documents. If they have to do one loan, if it's a one loan situation, then they'll charge them an amount that's less than a two loan situation. Some people get two loans to purchase a property. It just depends on their specific situation. So one thing you as a broker could do is call the attorney and say, could I get a fee sheet to share with my buyer, my seller? That's my buyer, really, because the buyer is going to pick an attorney. So they need to know, what is that attorney charging? What I've noticed is that attorneys in town charge a little more than some of the attorneys outside of town or in a more rural area. I've seen some attorney fees to buyer be $800 to $1,000. In other places, maybe into Charlotte, further than, say, some of the smaller towns in Cabarrus County, Charlotte might be $1,200. But again, it all comes back to what is the actual deal consisting of. Buyers have to pay for the escrow accounts being set up, the reserves for taxes and the reserves for insurance right next to each other there. Setting up those escrow accounts is something that the buyer needs to pay for. In other words, how many months of taxes is the lender requiring be set aside in the escrow account? That is going to depend on when in the year you close. You won't know till the closing, till the under contract period. What is the lender requiring for this closing? They want 3 months of taxes to be set aside? Okay, then the buyer needs to bring 3 months worth of taxes to the closing, to the settlement, so that can be sent over to the lender so that they can set up the tax escrow account. Same for insurance. Appraisal fee. When they applied for the loan, quite likely the lender said, we need you to go ahead and give us $400, $500 for the appraisal fee. If they paid that up front, then at closing, they don't have to pay it again. There will be a column on the closing statement that says what items were paid outside of closing. What items have already been paid for? You don't need to pay them again. We're just making a record that they were paid. That's an example of one. Appraisal fee might be one. Credit check fee, credit report fee for like $50. That might be another one of a paid outside of closing item. But the buyer did have to pay it. It's just when did they pay it? Inspection fees, that's a big one. That's what they're doing during the due diligence period, whatever they paid for inspection. Now, most inspectors want to go ahead and get paid when the work is done and the report has been given. And that is before closing, because too many people had a deal fall through and they got mad at the whole world, including the inspector, and didn't pay them for something the inspector did. They did what they were supposed to do. But they allowed the person to only pay them at closing, and the person never closed, and so the person never sent them a check. So many inspectors say, we don't play that game anymore. Once we give you, before we release the report, we'll do the inspection maybe, but before we give you the report from the inspection, you got to pay us. but that would need to be reflected on the closing statement too. Paid outside of closing, already paid. And certainly if it's something that still needs to be paid out, it would be there. Discount points, another lender related fee. Interim interest, here's one that's fun for everybody. So when are we closing? Let me just kind of explain what this is about, and then we'll get into the math of it later. But if we are closing, if we have a month of closing here, let's just say it's September. September is our month of closing. Let me do it this way. These are the next 3 months: September, October, November. If we close here, right here, and call that maybe September 21st, that's our closing day. Our first house payment for that buyer, the borrower's first house payment, first full official house payment, is going to be due here, because they're going to have lived there all of the month of October. And when you're paying a house payment, you pay it after you enjoyed it. When you're paying rent, you pay rent before the month that you're paying the rent for. When you're paying a house payment, you pay it after the month that you were there. You pay what's called in arrears after the fact. Because of that, the closing is going to happen, and the attorney is going to explain to that borrower, look, you don't have to make your first house payment until not October 1st, not then, but not until all the way here, November 1st, because you will have lived there in October and you get to pay for having lived there on November 1st. But that does not account for this amount of time, this little bit, because they're closing on September 21st. Yeah, October is going to be covered when they make their November payment, but what about these days? How many days are those? The days between the 30th and the 21st. That is called interim interest. We're going to calculate how many dollars of interest they need to pay in order to be given the permission to live there. Their new lender that they just partnered with, that they just borrowed money from, says, we want you to pay us interest for this many days. That is interim interest. It's a little different in the calculation because with interim interest, you include the day of closing. The lender collects from that borrower all of the days left in the month, including day of closing. And you might be thinking, well, what if they close at like 2 p.m.? They didn't get to live there the whole day. They have to pay interest for the whole day. You bet. Welcome to home ownership. Congratulations. Right? The lender says first day of closing is the first day of interest. Therefore, 30 days in the month minus 21 is 9 days. But let's not forget the day of closing. So the days of interest that buyer needs to pay is 10. That is the magic of interim interest. That is what people get wrong all the time. They lose track of the day of closing. They forget to count it. Because in every other proration or anything having to do with day of closing math, in every other one, especially the taxes, the day of closing is paid by the seller, not the buyer. This interim interest phenomenon is the only one where buyer pays for the day of closing too. Otherwise, the buyer would only pay for the 22nd through the 30th on some of these other items. But no, it includes the 21st when it comes to this, because we're not talking about both sides of the transaction here. We're talking about the buyer side only, the lender for the buyer. And that lender says, welcome to the lending family. We're glad to be able to make it possible for you to buy this house. Therefore, pay us for the whole day of closing, even though you're not going to own it for the whole day of closing. That's what interim interest is, and it is a buyer expense. The deed recording is an expense to the buyer, not the deed preparation. Don't mix them up. But recording the deed, and that's we're talking about maybe $100, $50 or $100. That is a buyer expense. Setting up the reserves, we talked about survey, anything else inspection related, due diligence fee. Oh, wait, how did we handle that? Because we're at closing, and in order to even get to closing, we had to have given the due diligence fee already back on when it went into contract. Well, due diligence fee is acknowledged to have been paid by the buyer. It is a credit to the buyer because they already have it into the transaction, as well as earnest money. Earnest money, write these things down. Both earnest money and due diligence money are buyer credits, not buyer fees, not buyer expense. They've already paid them. Origination fee, that's another one the buyer pays. Anything the buyer has to pay. Seller fees, they're fewer in number, but they might be pretty high in total. Commissions might be because of that they're pretty high. The real estate commissions are paid by the seller. The excise tax, we already know, paid by seller. Attorney fees, some of them, not all of them. Really just deed preparation. For your purposes in this class, they will make sure you understand who's responsible. If it's an attorney fee, they won't just say, what are the attorney fees? Who's paying for this attorney fee? They'll make it more clear. And usually they'll say the attorney fees and the deed preparation. And if that's what they tell you, then the attorney fee amount is going to be paid by buyer. The deed preparation amount is going to be paid by seller. If it's different than that, they will say so. Now, out of all these different fees, some of them are very date specific and the bills aren't due yet, maybe. So we need to calculate what's fair because of time of ownership. And that's called proration. We're prorating an amount of money we're taking from one side and giving to another side. And some of the things that can be prorated are property taxes, quite often, rent collection, if you're selling an investment property, HOA fees, if they've already been collected or need to be collected, and we're closing, of course, in the middle of the month, we need to split who was responsible for when. Now, good news, got a little tiny bit of good news for you. If you're worried about how many days in February or September or May, 30, 31, 28, 29, don't worry about it. For our purposes in this class, all of them have 30 days. You will have to do the math based on every month having a 30-day month. And therefore, by default, when you multiply 12 months times 30 days, that means the year has 360 days. Good. So that makes the math a little bit easier. When you get to post-licensing, especially 302, we do more closing math, but then you've got to do it with what's actually in the month. But for this, it's nice and round. In the cases of the taxes being prorated or the rent being prorated, the seller owns the day of closing. Why do we say it that way? When it's taxes, the seller pays for the day of closing. When it's rent, they get to keep the rent for the day of closing. So when it's a rent problem, it's not money the seller has to pay out. Let me say it this way. With the rent situation, here's a given month. We'll call it September again. When is rent collected? Before the person is using it. So the rent, the total $1,200 rent is collected on the 1st, but we have a closing happening here on the 17th. September 17th is when this investor owner is selling to an investor buyer. The investor owner already has this $1,200 for the whole month in their pocket. Well, that's not fair. We need to make sure that we split that up, prorate it. Let's make sure that we give that buyer their portion of the $1,200 for that very first month, right? So what happens to the day of closing? Seller gets that one. We just calculate 17 days to the seller. So how many days are in the month itself? We just learned that there's 30. Doesn't matter what the month is. $1,200 divided by 30 days means $40 a day. And how many days the seller's responsible for? 17. So the item on the closing disclosure for rent proration is seller is keeping $680. So what does the seller need to give to the buyer? The difference between that and $1,200. So it's going to be $520 debit seller and credit the buyer, because the 520 accounts for this chunk of time. And that 680 that we calculated first counts for this chunk of time. Seller already has it. They already have the entire 12. They need to give up 520 of it because they're not going to be the owner for those last 17 days, including, well, sorry. Yeah, that's right. Last 17 days, last 16 days, because it'd be day after closing that the buyer gets. So for rent, the seller keeps the rent on the day of closing. The day of closing's worth of rent, that extra $40. And let's see, for rent, for taxes, it's different. Seller owns the day of closing, meaning they have to pay for it. Seller has to pay for the taxes, including the day of closing taxes. Step one, when we're doing a proration, figure out what it is per year. What is the annual total amount? If it's a tax thing we're talking about, we're going to figure out the tax value times the tax rate. We're going to use the tax value, multiply it by the tax rate, and that's going to give us annual taxes. And then we divide in order to get daily taxes. If it's a loan, like an interim interest kind of thing, we calculate the total interest for the whole year by multiplying the loan amount times the interest rate. That gives us the total for the year. Then we divide by 360 days. Don't worry if this is going too fast. You will have seen it plenty of times. You will get it. We take that annual tax amount that we just calculated, divide it by the number of days in the year, for our purposes 360. Or if it's an interim interest situation, we take the full annual interest total, divide it by the days. Now we have dollars per day. Then the only thing left to do is to calculate how many days goes to which party and do that little bit of multiplication. If it's an HOA thing, then we're going to divide by 30 because we're talking about what's happening within the month of closing, not the whole year. We don't care about the whole year when it's these things. It's just how do we need to adjust for that month? Same for rent. Rent and HOA fees, probably going to be dividing by 30 to get dollars per day because it's a monthly thing that we're dealing with. Then we add up the number of days. If it's a tax situation, the seller's responsible for the very first day of the year, January 1, all the way up to and including the day of closing. The buyer is responsible for that day after closing. If it's taxes, through the end of the year. If it's some of these other things, rent or HOA, it's going to be through the end of the month. And then we determine what goes to whom, the big number or the small number. Debit seller, and I need to change this. This is the same thing. Debit seller, credit buyer, or debit buyer, credit seller. Or there's one situation in the taxes, depending on the time of year and what the situation is, you could end up debiting both sides. Neither one gets a credit. It's not an actual proration. We're not taking from one given to the other. We're taking from both their respective amounts. And that's for when we're closing after September 1st, but the bill has not been paid yet. The government says, we want to get money from both sides. We want to get the seller's portion and the buyer's portion, put it together and go ahead and send it to us. Because the tax bill is due September 1st. Remember that one? Can be paid all the way up until December 31st. You can wait until any sort of penalties start happening. So since it can be paid, it has to be paid. If we're closing on a house September 1st or after, got to send in the full tax payment. Take the amount the seller owes for the year, add it to the amount the buyer owes for the year, send it in. So it's a debit, each party their own amounts. The seller's portion is going to be bigger than the buyer because September 1st is beyond the halfway point of the year, right? So in this type of situation, you'll at least know to kind of double check mentally, is the seller paying more than the buyer? They should be, because we're closing September 1st or after, and that's after the halfway point of the year. Therefore, it should be bigger. So figuring out who gives something and who gets something. Okay, stand up, shake it out, do a couple jumping jacks, chew your gum extra hard, do something, stretch, because this is what we're doing now. This looks intimidating. It's not bad. You'll get it. Hang in there. It's 3 scenarios. This is the 3 possible things that could be done to make taxes reconciled, right? Depends on the time of year we're closing as to which one of these 3 things we do. So ignore this. We'll come back to this as a recap, but let's first kind of just watch what's happening. We'll come back to it. We have an entire year. January all the way to December 31st. January 1st to December 31st, we have a closing happening. Let's say that it's happening on April 3rd. April 3rd. What do we know about the year when it comes to taxes? We know that on September 1st, the bill comes out. It actually came out in August, but the bill can be paid. You can start, if you want to pay it, you can pay it as of September 1st. Those who pay bills early are probably paying it in that week, right? But even the lenders themselves don't often pay in that week. They will pay somewhere in November, but by the way. Well, that's when the tax bill can be paid, the soonest it can be paid. So it's at April 3rd. We close on the house on April 3rd. No matter how on top of things someone might be, they can't pay it yet. So that money needs to be handled before it can be paid. So when we close anytime before September 1st, here's how we handle the taxes. We calculate the number of days between January and the 1st, and April 3rd, or whatever the closing is. And those are the days to the seller. Those are the days the seller has to be responsible for, has to pay for. And then the rest of the days in the year are the days the buyer is going to have to pay. But we don't care about that number. If we're closing before September 1st, all that matters is we figure out the dollars that the seller's responsible for, and the attorney sends those dollars over to the buyer's side. Whether that buyer uses them to pay the taxes is not our concern. The closing is over by then. All we're concerned about is this day of closing and making sure the money is fair as of that day. We'll plug in numbers here in a second, but let's say we figure out that maybe the days responsible of taxes to the seller is $2,300. So the tax bill for the whole year, if from this much is $2,300, the whole year is probably going to be like, I don't know, maybe $9,100. It's going to be a big tax bill. Well, all we need to worry about is getting this $2,300 and debiting the seller and crediting the buyer for that amount. The attorney is taking that $2,300 from the seller, from their side at closing, putting it on the buyer's side of the statement. So when they tell the seller this, they'll tell the seller something like this. They basically will say, okay, your entire proceeds from selling this $400,000 house are $50,000. It's hard to read. $50,000 is what you're going to get from the sale. Oh, wait, I forgot though. You've got to pay $2,300 over to the buyer's side for your tax bill from being the owner January 1 through April 3rd. So you're going to get, what is that? $47,700. That's what you're going to get, seller, for the difference between the 50 and the 23 because of the tax bill. It's that much less the seller's getting. And then on the buyer's side, it's going to be a credit. So the attorney will add up the numbers that the buyer's getting all the credits the buyer's getting, they're getting a credit for their earnest money that they already put in. They're getting a credit for their due diligence money they put in. And they're getting a credit for this. So it'll be $2,300 for taxes because they need to pay the tax bill. The buyer's going to be the one who owns it on September 1st when the taxes need to be paid. Therefore, we need to put into the buyer's hands the $2,300 to account for these first few days in the year when they weren't the owner. Does that make sense? It doesn't matter how much the buyer's portion is in this scenario. They're going to add that to the $2,300. We just need to make sure they get the $2,300 in their possession so that this chunk of time where they weren't the owner, which is also going to be due when the tax bill's due, the tax bill is going to be the total due, right? The entire tax bill is going to be paid at the same time. It needs to be consisting of both the seller's portion for the year and the buyer's portion all put together. No. We're talking about, okay, so closing has happened April 3rd. Seller hasn't paid anything yet. Right? But what they're, yeah, but we don't, but those are done. We don't have to account for those here. Last year's, we're only dealing with taxes this year, because last year's are paid for. That has nothing to do with this closing that's happening right now. Right? You with me? That's back here. Last year's all settled. All we need to worry about is the tax responsibility for this 2022. Let's just say we're dealing with a closing on April 3rd, 2022. And so in order to do that, we need to figure out the seller's going to be gone. When the tax bill is actually due on September 1st, that seller's out of here. They've been gone several months by that point. But let's make sure we get $2,300 from the seller at closing and give it to the buyer so that the buyer can add the $2,300 for this part with the, let's just say $7,400 for the rest of the year's worth, and add it together so they can send the entire tax bill in when the whole thing is due. All we're doing is getting this seller's portion over into the buyer's possession. That is prorating it. The entire dollar amount, let's do a real dollar. Let's do a real one with real numbers. That might make more sense. Let's do it that way. So, first of all, I'll spare you this. Let's just say that the actual annual tax bill is $4,800 for the year. On the test, they might make you calculate the annual taxes by multiplying tax value times tax rate. But we're just trying to figure out how to do this proration, so I'm not going to put you through all that. The tax bill is $4,800 for the whole year. If that seller never even sold the property that year, they would have to pay $4,800. But they chose to sell. On April 3rd is the closing. Because we're closing before September 1st when the bill can't even be paid at all, then we need to prorate, which means first we need to calculate how many days is it from January 1st to April 3rd. Well, that's as easy as saying January, February, March, 3 total months of 30 months each. 3 times 30. And that is what? 90 total days plus the April days. How many? 3 of them because it's April 3rd. So 93 total days to seller is what the seller's responsible for. Out of that tax bill of $4,800, how many dollars worth is 93 days? We need to take that $4,800 total and divide it by something. What are we dividing it by? You got it. The number of days in the year. 4,800 divided by 360 means our taxes on a daily basis are $13.33. Let's just say $13.33. That's how much per day. We can't pay taxes per day, but that's how much the math turns them out to be. Now that we know the tax dollars per day and we know the number of days the seller's responsible for, we can multiply those two things together. 93 days the seller has to pay for times $13.33 means the seller's obligation of taxes for this year are $1,239.69. So out of the entire $4,800 tax bill, the seller's responsibility, including day of closing, is $1,239 and some change. So what are we going to do with that number? We're going to debit it. Debit the seller, meaning take it from them, and we're going to credit it, that same amount of money, to the buyer. So on the settlement statement, it'll say debit to seller, credit to buyer of $1,239.69. Does that make sense? Literally. Dollars. Does that make dollars? We're taking the dollars of this time period because that's the seller's responsibility. And they can go off and move to Mexico and never be heard from again. We don't care as long as they leave the $1,239 they owe for their tax burden behind as of the day of closing, so that when this due date rolls around, the buyer can add the $1,239 to the amount that they're responsible for. How much is the buyer responsible for? It doesn't matter, but it's this much time's worth. That the amount in dollars for this type of problem don't matter. When it's a before September 1st that we're closing, we don't care what the buyer's portion of taxes are. They don't need to show up on the closing report, on the closing statement, because the buyer's just going to pay the whole bill when it comes due. So we don't need to reflect it on the closing disclosure. It has nothing to do with this closing day. The only thing that matters is getting this money from those first 93 days into the buyer's possession. So we need to acknowledge how much money that is. Right? Yeah, I'm not sure what I was getting at there. I think I was just talking about the difference between a debit and a credit. I was just trying to explain that the seller would be getting out of the seller's proceeds check that they're getting at closing, they will have paid out the taxes. That would have been one of exactly. You got it. You got it. Just one of several of their expenses. They won't get a check until this $1,239 has been taken away. They'll get the check after that money has been accounted for. Now this is what you do when it's a closing before September 1st. There's three possible scenarios of depending on three closing times. Let's look at another one. It's a little bright. So back to the little timeline here. January 1st, December 31st. We have, first of all, September is what matters. That matters because that's when you can even start paying your taxes, tax bill. That's when it's due. So closing can happen when throughout the year? Well, it could happen anytime before September 1st. And as we just learned, the way we're going to handle it when it happens in this time frame is we're going to figure out the seller's portion, and then we're going to debit the seller and credit the buyer that amount of money. That's how we're handling it if the closing happens before September 1st. But that still leaves two scenarios. Why do I say two? There's only one other half of the year left or portion of the year. It's because of did they pay it or not? Let's say that now the closing is happening in October. Let's say it's going to be October 30th. That's when closing is happening, October 30th. Okay, what do we know? It's after September 1st. Therefore, the bill is due. It may not have been paid yet, though. And that's okay if it hasn't been paid. The seller has the right not to pay it all the way up until December 31st. But let's say that it has been paid. It's a seller who's very responsible. They've paid the whole year. Let's see, what was that amount? That was I think we said $4,800 for the whole year. The seller has paid $4,800 out. Well, do you think that seller is just going to say to the buyer, you know what, consider that my gift to you. For the privilege, thank you for buying my house. I'm not going to ask for any money. You can just have the whole year's worth of value of taxes. I got it covered for you. Well, no, they're probably not going to say that. They've paid for the whole year. Who's going to be the owner for part of this year? The new buyer. And how much of the year? This part. That seller probably wants this much money. If this red line is $4,800, that seller wants however much money this is. They're not going to let that buyer enjoy living there those last 2 months tax-free, right? So that's another scenario. That's the other proration possibility. What do we know? We figured $13.33. Is that showing up okay? $13.33 per day. We'll just piggyback on those same numbers. That was how much the taxes per day are. Now we need to figure out how many days is the buyer responsible for? Because that's what we have to give back to the seller. What we're going to need to do is credit the seller, because they're out of pocket for the whole year's worth, and that's not fair. We're going to have to credit the seller and debit the buyer. But what amount of money? The buyer's portion. That's what you're asking in these problems. What are we doing with it? Credits versus debits. And whose chunk are we talking about? Seller's chunk or buyer's chunk portion, right? So next step, count up the days. And if it's the buyer's portion we're talking about, what day do we definitely not include? Tell me in the chat, what day are we not going to include when we're calculating the dollars that equal this many days? You got it. Will not include the day of closing. Now, here's my warning. Red alert. Lights flashing. Warning. I know it's tempting because there's only 2 months left in the year. When it gets real close to the end of the year, it's really tempting to only add up the buyer's days, like almost in reverse. You're thinking, how many days are left in the month? I promise you, you're going to lose track of the day of closing if you do it that way. The most foolproof method of not screwing up when your mind is tired and forgetting where to add the day of closing is to always calculate seller's days, even if it's all the way toward the end of the year, and then do subtraction from the total in dollars to figure out the buyer's portion if that's what you need. Let me explain. Let me show you instead of telling you. So we know it's $13 per day. We're calculating days now. How many days is the seller responsible for? All the way up and including October 30th. How many months? How many full months are up until the month before October? October's the 10th month. That's 9 months, right? 9 months times 30 days a month is 270 days. And then how many days in October? Well, what's the day of closing? 30. So that's how many days. In fact, because of the way the math works, we could have just done the full 10, right? I was just for a moment thinking about Halloween. So this turns into 300 days. We've added it up, and including the day of closing, the seller's responsible for only 300 out of the whole 360 days. We need to give them back 60 days worth of taxes. So what's 300 days worth of taxes? The seller's portion of days is 300. The dollars per day is $13.30. The seller's portion is $399.99. Sorry, $3,999. We know the total is $4,800, so let's just do that math. $4,800 for the total bill minus $39.99 means the buyer's portion of days that we need to credit the seller with is $801. I don't know where to write it. 801. This is what's going to happen. We're going to credit the seller with $801. We're also going to debit the buyer of $801 because what we're using that 800 for is because it's the buyer's portion. Seller paid for the whole year. We need to give them back however many days that ended up being. 60 days. Right? That's when we have a closing that's after September 1st or after, and the bill has already been paid. So those are the two possibilities out of the three. So those two are the ones that are involving a proration. You with me, or you want to do another one like this? I didn't see faces, but I'm going to say, let's do another one. One more time here. This time, let's change it up a little. Take that off too. All of this is the same, except now our closing is going to be November 18th. That's our closing day. The total tax bill for the whole year is $8,300. And here's the other important part when you see these questions. When is it? It's closing September 1st or after, because it's November 18th. And then the next question is, or the next piece of information you need to know is, have the taxes been paid already? And they have been. They have been paid. We're going to do one more of these. That means the seller has paid $8,300 for the whole year taxes, but they deserve to have this chunk of the year of taxes back reimbursed to them. We need to figure out how many days. Resist the urge, even though it's only just a few days at the end. How many days are in the months up to, not including November? 10 months worth, because October is the 10th month. So 10 months at 30 days a month is 300 days. Plus how many days in November? 18 of them. Oops. So we're dealing with 318 days to the seller. Be very, very clear on that. The seller is responsible for paying 318 days of taxes. How many dollars is that? Okay, what's the whole year? $8,300 for the whole year. Divided by the days, it's $23.06 a day. Multiply that by the days to seller. Take my word for it. Notice what I'm doing this time. I did not clear out the calculator. I just left it in there. But again, they won't give you answer choices that are so close that will cause it to be wrong. Just depends on what you might have done. And you just might have gotten a different number than I did by a few cents. But the number I got is basically this. $7,331 is the amount the seller is responsible for paying. But they paid $8,300, so we need to give them the difference. So what happens when you take $8,300 and subtract $7,331? 67. We are left with $968.33. What do we need to do with that? This is a proration, so we are crediting the seller and debiting the buyer. We're basically seeing, what is the buyer responsible for? Therefore, let's give that back to the seller to make them whole again, because they're out of pocket the entire bill. They need to only be out of pocket 318 days worth. Good? So both of those are the proration examples of how to handle a tax calculation. Here's the last of the three possibilities that you could see on the test. This is not a proration. We are not calculating an amount of money to take from one and give to the other. This third one looks like this. Here's the year. Here's our September. Here's our closing. We'll call it, well, let's call it the same thing as last time. What did we have last time? We had 73.31. We'll just round it up to dollars. 73.31 and 968. We'll do the math later, but we've already done it for the last problem. We know that the 73 number is the seller's portion. And the 968 is the buyer's portion of the year they're responsible for. Right? So the 73.31 is this. The 968, let's do a different color, is this. So how do we handle it when we have a closing that's September 1st or after? I just asked you that. And now your question back to me is, well, yeah, but has the seller paid them or not? And what I'm going to tell you next is the seller has not yet paid the taxes. They've not been paid. Last time they were paid. This time they're not. This is a seller who has not yet paid them. Since they can be paid, it's possible to send the check in because it's available now to be paid. Well, the government says since you can, then you must. Therefore, we're going to debit the seller this amount of money, and we're going to debit the buyer their portion of the year too. They're not going to let the seller just give 73.31 over to the buyer to be put together with the buyer's portion to be paid on December 31st. They're both, the total bill is payable. Therefore, let's take the required amounts from each party at the same time. The attorney will take both at closing, and they will add them together and send one check in. The attorney's going to pay the taxes this year. They're the ones who are physically going to send in the payment. They're going to give the seller $7,300 less than they would have normally gotten, like they're less on their proceeds because they need to cover their own taxes. Then they're going to add $968 to the amount of money the buyer needs to bring to closing because it's another buyer expense. And they're going to add these things together, the attorney is, and they're going to send that bill off to the government because it's closing in this time frame and they have not yet been paid. Let's go ahead and get them paid. You with me? So now this might make more sense. January 1st through August 31st, the taxes are not yet due. They can't even be paid yet. Therefore, how do we handle them? We're going to calculate how many dollars worth they are, and we're going to debit the seller and credit the buyer the seller's portion. Need to add that to this slide. We're going to debit the seller, credit the buyer. How much? The amount the seller is responsible for, because we're closing on a day that's before September 1st. If it's another example, this middle one, where it's a closing after or September 1st or after, the next question is, were they paid yet or not? If they were paid already, we're crediting the seller and debiting the buyer. How much money? The buyer's portion. Because the seller is out of pocket for the whole year, we need to give them the amount that the buyer is going to be the owner. And then the third possibility is not a proration at all. You don't see any green. We're debiting the seller the amount they're responsible for January 1 through and including day of closing. And then we're also debiting the buyer the tail end of the year. When it's this situation where it's a debit to both, it will always be a larger number debiting the seller versus debiting from the buyer, won't it? Because the closing is September 1st or after, and that's after the midpoint of the year. That's one little thing, a little clue you could look for. And sometimes on the test, they won't even make you do all this fancy math stuff. They'll just tell you, like we kind of did just now. They'll say the seller's portion is $7,000. The buyer's portion is $2,000. We're closing on September 7th, and the taxes have been paid. How do we handle it? And so the answer choices will be this: $7,000 credit seller, debit buyer. $7,000 credit buyer, debit seller. $2,000 credit seller, debit buyer. Or $2,000 credit buyer, debit seller. So you don't actually have to do calculation. It is therefore not one of the 8 calculation problems that you know you're going to have. So they slip in a math problem on you without it being an official calculation problem. So you just need to know what to do with what. You know we're close. It's going to be a bigger number to the seller, but have been paid. Therefore, even if you have to do this and draw it out. September 7th, is that after September 1st? Yes. There's September 1st. There's the 7th. So this chunk is for the seller, 7,000. They have been paid. Therefore, we need to give the seller back the buyer's portion. We need to credit seller and debit buyer the 2,000. So which of these answers says that? I believe it's C, right? How do we feel? Good? Those are 3 of the tax possibilities. Just as a recap, let's do another one. This time, let's make you work a little harder. It'll be just enough time. What we have here is a sale price of $347,000. We have an assessed value, of 75%. We have a tax rate of 12 mils. Busting out the mills on you. We have a closing happening. May 24th. How will taxes be handled? How will the taxes be reflected on the closing statement? How much going and coming to whom? Debited and credited from which parties by how much money? All right. Do we have enough information? Do we need to know if the taxes have been paid or not? Have the taxes been paid or not? How do we know? Yeah, they have definitely not been paid. They cannot be paid. It's not September 1st yet. Right. So that was one clue. All right. Now, first step, figure out the annual tax bill. How do we do that? Well, we need the tax value. We're going to use these 2 pieces of information to get the tax value. Tax value is $347,000 times 75%. Tax value is actually $260,250. That's our tax value. Now we're going to use that down here. We'll just do it in our little circle formula. $260,250 tax value times the mills, but don't forget to divide the mills by 1,000 to get the right decimal. So take our $260,250 times and our tax bill annually is $31.23. Is that what you got for tax bill for the year? There's our total for the whole year. Now we need to figure out dollars per day of taxes. Let's do a little this, dollars per day. And that's just going to be the 31.23 divided by 360. So we're dealing with $8.68 per day. We know the dollars per day. Now we need to figure out the days. Well, first of all, let's really think so that we know which thing to do. It's closing May 24th. So what are we going to do? We're going to take that timeline. Here's May. We're going to calculate the seller's amount. So that's what we need. We always need to calculate the seller's amount. Seller's amount, and we're going to debit seller, credit buyer for the seller's portion. So now how many days is the seller responsible for if we're closing on May 24th? The month before May is April. That's the 4th month. 30 days times 4 months. It's 120 days plus another 24 days for the actual month of closing. It's 144 days the seller is responsible for. At what rate? $8.68. So seller's dollar responsibility for taxes is $12.49.92, and we already figured out what we're going to do with it. We're going to debit seller, credit buyer. If you got more than that, it might be because you used a purchase price instead of the tax value. Right? Do you remember to use the sale price and get 75% of that to get the tax value? How's that?